Yep.
In and out of full screen. Don't you for doing that. Sorry.
Don't worry about it.
Thank you for attempting to get that.
Did you check the mic?
Not yet.
What do
Just slide switch on the side.
Yeah. Just give it a test real
I
quick.
clicked custom stream.
Check.
You're fine. Let's do it. Yeah.
All right.
Now-
Are you okay right there?
Live stream. No,
Can you
it's,
hear me in the back?
it's going.
Ah, on the stairs. All right, that's fine. Good.
Does this click? Does this need to like?
Slide switch on the side. otherwise-
Yeah, okay. Here's your clicker. Okay. Do you want me down here? Or do you want me to just? You know what? Maybe for the first one.
Okay.
Okay, so I just don't want to be in the wall.
So I'm gonna just go ahead and sit.
Are you gonna
on the
sit?
podium right next to you.
You can't sit.
I'll work on that shortly. I don't know.
No, it's the same.
Oh, they just-
You need to unmute the. Wait, is the mic working?
Test is earlier. Test the mic.
Mic check.
Can you?
Do it again.
Mic check. Mic check. Testing. Testing.
Are you getting audio on the screen?
You can hear it out here in the auditorium.
Getting.
You have it on video.
It's going across.
And it looks good, the video looks good. Okay. So can you check again? Just tell me.
Check,
keep
check,
up.
check. Mic check. Mic check.
Checking the
There's a
Zoom
pop-up
audio.
on the screen. Where's system resources? Check it. Mic check.
That's good, thank you.
Is there a way to do what, is there a way to make the screen a little brighter?
Like, do you can these three lights turn or these ones? Do you do that one? Without
There is a
being
switch to
speaker bar?
turn off the lights above the screen. So on the stage spotlight, there should be a switch next to it to just turn off the
Slider next to the.
There should be a second switch that
I mean,
turns
the
off
screen and.
to
Keep
lights
your back up.
above this, there, that one, exactly. And then ramp, yep. Start
Yeah, it
up.
doesn't really. So I guess we'd rather the live people see.
You see me all right?
Thank you. Throw the-
Go ahead and grab a seat because I'll do an introduction real quick.
I went back to going.
Can we move up a little bit? Can you look at the bracelet actually?
Do you want me to stand at the podium, Michelle?
Yes, please.
Why are you doing this?
Because this is.
How much adjust up?
That looks good. That looks good. Look at this one.
I like that. You like your, maybe it needs to go up a little bit.
Why did it do that?
Oh, good.
Yeah.
If you need that height and breathe, oh, it's as close as it's gonna get on the outside. Got it. I see. There it is.
That's
Okay, so if that camera does that again, I'm using these two.
The arrows, yes.
Okay.
So if you press the right arrow, your screen goes to that.
Okay.
You're not facing it.
Not
Press
just
this way.
facing it, okay.
So if you press right on that keypad, the camera will turn.
Okay. And
Do you want me to take a pen and adjust your stuff? Does anybody have a pen?
Oh, I see. I was calling him for that. Okay, I got it. I see it here on the floor. Gotcha. Okay, sweet. All right.
Are you
This.
Oh, I had that over.
Okay. Is that yours too?
This is what I just don't get the gauge down.
All right.
Correct.
You guys ready?
Yeah, we're ready.
All right, I'm gonna, well, people.
Sounds good.
Keep going. Okay. Good morning, everybody, and thank you for joining us. The first thing I want to do is take a second to let everybody know, certainly we have a large virtual audience. The schedule's been adjusted a little bit. You can find on the website kind of the updates. Some of the presentation times have moved slightly, and that's because of the weather here in Colorado. So thank you for being flexible. Thank you all for being flexible. I know we have people arriving, and we'll get them downstairs here in Freyhoff Hall as soon as they arrive. I want to thank Colorado School of Mines for hosting us here. I want to thank them for bringing the weather so that you can all experience Colorado. I want to thank our sponsors, Engage, Neighbors Industry, Haynes Boone, Moss Adams, Gary Climate Solutions, and the City of Golden. I want to thank them for sponsoring. Without them, this would not be possible. So we appreciate that. I want to thank my team from EnerCom, who are working diligently with a little bit of hybrid technology with the university, as well as the technology that we do to broadcast this as a live web stream. So appreciate that and appreciate all our team's work. And then I want to thank all our presenters and attendees that are here in person. You can find Morgan Bazillion was our keynote speaker this morning. We recorded his presentation last night, and you can find that. That'll be online live stream and available for you to review at another time. We just wanted to make sure we gave everybody plenty of time to drive here today and get here safely. So we will kick off our presentations. We got a great slate of incredible companies. I call them gritty. A lot of these are bootstrap companies that are have some great technology, need some capital. So please pay attention, listen closely. And I want to encourage everybody that is an angel investor, is a venture capital investor, to reach out to these presenters because some of these ideas are very marketable. So our first presenter is with Remote Gauge, Momus Collaborate.
Hey, and thank you and your staff for bringing us here today together. You guys have done a magnificent job. Good morning, ladies and gentlemen. My name is Momus Collaborate. And today I get to introduce you to Remote Gauge. How many of you know what this is? We're going to demonstrate this very high-tech tank gauging method too. So that is what we use in the oil field to measure this very valuable asset. If you've used one of these, or if any of your staff have to do it, I forgot to turn on the timer. Or if any of your staff have to do it, use it at any of your operations, you're not alone. In the continental US, there are over 3.5 million tanks that are still measured with that device. Here's a hand gauge in use on a typical 25-foot tank. The red sock shows the direction of the wind, but its presence there is a warning that the vapors in this tank are dangerous. The gases from this well are explosive and deadly. Hydrogen sulfide gas in high enough concentration can kill you with one breath. So why do we still measure tanks this way? Because the fluid in a production tank is a crucial piece of information. It's the way we track a well's daily production and a sale of oil as it transfers to a truck and wastewater disposal costs. And it's the best way to prevent spills. Here's the scary photo of the day. No one in the oil business wants to see this. There are lots of devices available to measure tanks. You've probably seen them. You may already have some. Over 1 million tanks in the US already have expensive monitoring systems. But the huge capital cost of this equipment and the cost of installation, maintenance, transmission, and viewing the data are just too high for a vast majority of tanks. So most oil is still gauged with a rocking string. We have hundreds more customer stories about cost savings, spills prevented, production restored. Because the fluid level in a production tank Remote Gauge is a tank top to desktop system that for $10 a day includes everything required to gauge tanks remotely and do the reports. This is a customer's screen from Christmas Day. You can see clearly what's going on in these 10 tanks. Green is oil, blue is water. The green dots are sensor reports, and the white dot is the load line, where the producer sells and the buyer buys the oil. I use this example on Christmas Day because one of the tanks just reached 80% full and is in what we call yellow alert. A text went to the boss and to the pumper at 6:02 p.m. to let them know the tank might need attention. The pumper went out there, not so much because of the high level, but because production had fallen from more than 20 barrels a day to less than 4. Sure enough, he was able to clear a valve and get production going again. Do you think this would have happened so quickly on a major holiday without the remote gauge alert? We have hundreds more customer stories about cost savings, spills prevented, production restored, revenue errors corrected, and thieves that got caught. Imagine for a moment you are the pumper responsible for these 9 tanks on 7 different wells, many miles apart. You used to spend several hours every morning riding the fences to each site and gauging each tank just to find out what you had to do that day. Remote gauge now can tell you on the screen while you're having your coffee this morning that there's a tank leaking. And you better get out there as soon as possible. On your way, you can call a truck to this tank to sell some oil. You also need to get the wastewater out of the bottom of this tank. And then on your way back, you can drive by this tank to find out who rolled it. Someone took a truckload out and put it right back in. This is illegal, but it happens all the time. Thanks to remote gauge, your day is mapped out before you finish that cup of coffee. Now, if you're the boss, you think it's worth $10 a day to fix this leak quickly? Will this system save your plumber many hours every day? Can he use that time to pump and sell more oil? These are just a few of the things that make remote gauge a no-brainer. Here's how we do it. The remote gauge installs on any tanks up to 26 feet tall. It reports oil and water by tenths of an inch. And it also sends the temperature of the entire column of oil. Our self-contained controller communicates by satellite from any remote location with no wires, no trenching, no poles, no networking, no calibration, and no need for cell phone coverage. Because your reports are transmitted by satellite from any place on the planet. It's presented across our blockchain encrypted web portal, available anytime, anywhere, to any internet device, without apps or downloads. Just drop our sensor on your tank, and it will deliver satellite reports by text, by email, or to our web portal, or to your own data system. Your tank is gauged every 5 minutes, all day, every day, and a satellite report is sent when there's a reason to, and you define the reasons. The web portal makes it easy to change alerts to suit each tank individually. We designed our system with operators in mind, but if you have a hauling company or you buy oil, remote gauge can prevent turndowns, eliminate short loads, and help you gather split loads to optimize routes. We offer the whole system as a service for $10 a day. $299 per month per tank with no other charges. This includes use of the sensor system, all of your satellite messages, and unlimited use of our web portal. And by the way, your monthly production reports, create them automatically with remote gauge and file them online with no additional cost. We're so confident you will love your remote gauge and keep it for good that we offer 3 things. Try it for 60 days for free. Use it month to month for as long as you keep our equipment. And it works every time, all the time, or we replace it. Send an email or give me a call, and we'll get remote gauge to work for you. Now some details about the company. My partner is a seasoned oil field entrepreneur. His portfolio of drilling and exploration and saltwater disposal and pipe reclamation and production ventures spans over 60 years. I've been in the oil business since 2008, but it never made sense to me that we track oil with a rock and a string. He and I both had the same vision. We had to create an electronic replacement for the hand gauge. We invested over $7 million to develop our patented remote gauge sensor and the bulletproof web portal. We chose the Iridium satellite network to carry our data because cell phone coverage is so unreliable in the oil field. Our new remote gauge system is the only system a customer can drop on a tank themselves with zero capital expense, warranted equipment, and a monthly cost that pays for itself many times over. Here's competition in the traditional supervisory control and data acquisition space because of the huge markups. Our remote gauge fee-for-service model flanks these competitors to the huge market where traditional automation just plain costs too much. Our only real competitor is reluctance to change. To remove the risk for the decision maker, we offer the free trial, the month-to-month service agreement, and the full warranty. And our recurring revenue model is a fit with the long life of oil wells and the perpetual value of the information. We project at least 90 months of revenue from each device. Right now, we're ramping up production. Our goal is to place 3,000 systems in service over the next 24 months. RemoteGauge does several things in addition to improving the ability to see what's going on in the tank. It reduces risk by preventing spills. It reduces liability with fewer trips up on top of the tank. This is an infrared image of the gas that blows out when a hatch is opened. It's dangerous to the employee, and it shows why there's a regulatory storm brewing. Here in Colorado, the AQCC Rule 7 allows huge fines for hatches left open. In New Mexico, the NRWC Regulation 19 requires monthly reporting of all the gas that's vented. And in DC, HR 1492 demands that less than 1% of gas be allowed to escape. If your hatch can't be opened and your revenue won't support expensive automation, RemoteGauge may be your only alternative to shutting in the well. We are seeking a strategic partner that can bring a $5 million equity commitment funded over 10 months. It should get us to positive cash flow by the end of this year. And a $15 million loan commitment to manufacture 3,000 devices funded based on customer orders. By the end of 2024, we project a $50 million net profit on $80 million of total revenue. If you'd like to be a part of RemoteGauge and help us make oil production more productive, I look forward to visiting with you. Thank you for your time and attention.
Thank you, Coach.
All right, our next presenter is Maurice Dukes. He is the the CEO of Petro Funders. Maurice, thank you for joining us.
Okay, great. My name is Maurice Dukes. I'm the CEO and fund manager for Petro Funders. Petro Funders is a fintech powered investment platform that aims to open up access to the oil and gas community when it comes to investments and capital raising. We'll go through a bunch of this stuff. In terms of the problem and solution that we're solving or addressing, typically we are looking at two different customers, if you want to look at it that way. There are the sellers or companies that need capital that range anywhere from 1 to 25 million. That's kind of a dead space for a lot of capital placement, whether it's a company needing access to capital to do a workover program, or a company needing access to capital because the banks won't give them more leverage in the current environment, or it's royalty owners, mineral owners who want to take some capital off the table from higher oil prices. So accessing capital in that range typically is too small for the big banks, too large for the smaller guys. On the equity vehicle side, So facing the investor, there's not a very easy way to invest in the oil and gas industry when it comes to having direct ownership. Sure, you can invest in stocks, bonds, mutual funds, there are MLPs out there, but there are not many direct investments that's easy to understand, easy to access, and you don't have to have $500,000 to participate in. So we'll be solving both of those problems in terms of the oil and gas industry. The solution that we're bringing to the table, we have 4 legs of a table or 4 legs of a stand that we'd like to kind of focus on. There's the Fintech powered investment platform. This is really important when it comes to scaling your business. So right now, whether I have 100 investors or 10,000 investors, it's an incremental change to the way I do business. And that's largely based on our ability to leverage Fintech. And then on the transparency side, again, basing the person that we may be purchasing an asset from in the oil and gas business, we have really simple terms, really competitive vehicles, and we'll get into the vehicles that we offer on our platform here in a second. But more so to the investor, it's a lot more transparent than your typical private placement deal. So most people here, if you invested in any sort of oil and gas deal, it's probably been a Regulation D offering with a PPM and the whole 9 different models within that structure. But we don't use a Reg D, we use a Reg A, so Regulation A fund. We have just got qualified the first royalty income fund through the SEC that uses a Regulation A structure. And that's really important because that has much more transparency than your typical Reg D. We have audited financials. We have much more of an obligation to provide a higher level of transparency, and that works really well for the introductory level product that we're launching. Reduced risk. We have decades of industry experience, so typically my peers are all fund managers. We all manage funds. We'll get into the product after this slide. But my background is in reservoir engineering. Our team's background is in upstream, capital placement, capital management. So we're really comfortable doing deals and understanding how to evaluate deals appropriately and on an efficient basis. And then compliance is the major portion of our business. Being that we went the Regulation A route, we're also treating our products as a security, which is very different than your typical PPM offering. We're regulated. We have obligations and reporting obligations that are enforced by FINRA, SEC. We also, the managing arm of our product is also an RIA. So it has another level of fiduciary obligation that comes with that. How this works for investors. So again, facing investors versus facing companies in the oil and gas industry. They're able to log on to our platform, explore the different offerings that we have, explore the different investment vehicles that we house. Right now we have our RIF 1, so RIF, it's a royalty interest fund. You'll understand that here in a second. And they get to review deal terms. It's really simple, so no waterfall models, very simple structure that retail investors can understand, but also institutional investors that typically don't invest in the space. So we work with a lot of family offices that might be new to the space, not have any current offerings or capital in the oil and gas market, and looking to kind of dip their feet in, and the deal terms make a big difference there for those outfits. They're able to select their investment. Right now we have 1 to choose from, and then you sit back and collect the checks. So it's really intended to be more of a mailbox money situation where you're not putting too much work in, you're subscribing to a fund, you're not actually investing in a particular deal. You're subscribing to a fund that has the terms already set forth, and you move from there. So right now, overall, conceptually, we have ideas for a bunch of different types of investment vehicles, but we only have one that's up and running, and we're looking to scale up, and that's going to be the royalty interest fund. And we came up with a royalty interest fund RIF kind of a play on words against a REIT. So many people are familiar with REITs in the real estate market. We've designed it to be very, very similar to a REIT, where people who invest in a REIT, they're subscribing to a fund. That fund manager is going out and deploying capital into the marketplace, buying cash flowing commercial properties and giving that cash flow back to investors. We do the exact same thing, except we are buying cash flowing royalties. We're not playing the upside game. We don't care about future development date and trying to guess that correctly. So we're not quite in the brick and mineral space. We're more so an income vehicle. So typically we're working and marketing this to financial advisors, wealth managers, family offices, broker dealers, other RIAs that's looking to place capital into the market. And so far as it's gotten some really good traction in terms of interest and people who are interested in getting yield and income, some of which are using this as a hedge to their portfolio in terms of getting direct cash flow and income from a royalty vehicle. And then when we're basing companies, it becomes a financial instrument. So this is another item for them to carve off an override, potentially raise money through this type of vehicle. And since we're competing with REITs, we're able to place capital at a decent rate that typically works for a lot of outfits, whether it's a royalty owner from a land component or an operator who's looking to take capital and put it to work. Kind of diving into our current flagship product a little more. So this is an investment fund created specifically for the purposes of purchasing a diverse portfolio of oil and gas royalties. So we're agnostic in terms of where we place capital, locale-wise. What we're trying to do is put together a really diverse portfolio of assets that are producing cash flow and create an income or a yield vehicle for the investors in this particular case. Being that we're a Regulation A fund, you don't have to be accredited. So that's a really big component. We have really low investment minimums. And so the barrier to entry is really advantageous to all investors. It's $10,000. And that's where the fintech part becomes really, really important, because you're able to curate a lot of investment at once without the time sink that typically would come with working with thousands of investors. This particular vehicle aims to deliver distributions on a quarterly basis. Again, made possible through Fintech. It's a LLC, so we're delivering K1s. We're passing on some of those taxable depletion items, which creates a tax efficient or at least tax advantage vehicle that a lot of portfolio managers like. And we're aiming for a target return of 9 to 11% IRR. So this, again, is going to be competitive with the REIT class of investment vehicles. And in many cases, we think we outperform. So our business model, very simple. We get paid in two main ways. We're going to have the assets under management, really more of an assets deployed, capital deployed component. So we charge right now on RIF 1, 1.75% on the capital that we deploy. And then we have a 5-95 split. So we get 5% of the distributions for the life of the fund, and 95% goes to the investor. So compared to other commercial real estate type products, this is probably one of the lower cost vehicles that you'll see for retail investors and institutional investors. Again, we want to make it really simple, so no waterfall models, no private equity type setups. From that standpoint, we'll just make it super simple and try to make sure we also have some economic alignment. So we'll be investing in the fund as well as a company and creating some alignment with our investors, additional alignment with our investors. Traction today, we will start off with the pre-seed round that we did. So we did a round last year and raised close to $900,000, single cap table entry there. And we've taken that capital and put it to work to actually bring this to fruition. So at the time, we were pre-platform, pre-MVP, pre-product. Since then, we designed a financial vehicle And it's been qualified by the SEC with first Regulation A offering to offer access to royalty income. And, you know, we had no clue how we would do that, how long it would take, but after a lot of time with lawyers and a lot of money spent, we've been able to do that successfully. And with that particular vehicle, that is going to be on the platform. We've designed the platform, built it out completely, made sure that it can be automated so that we can collect capital in a very efficient manner. And from a fintech platform validation standpoint, this is a proven model. This has been very successful in the commercial real estate business. There are a bunch of different examples you can look at in that sector, and with minimum buy-ins ranging anywhere from $1,000 up to $250,000. So we feel very comfortable in the technology that we've been able to assemble and leverage from the commercial real estate world. From there, we're really looking to customize and make it unique for us. We have certain tax advantage items such as the 15% completion allowance that commercial real estate doesn't, right? So we have to be able to alter our fintech portion of the company to make sure it's suitable and moves to our particular stuff. Main competition, we have two main competitors. Fundrise would be one. They also have an income product. Energy Funders would be another. Energy Funders is more so first to market in this space, but they don't have the type of income product that we have that focuses strictly on income. Those are two of our main competitors. But the advantages that we have is from a technical expertise position, we come from the industry. We evaluate deals very differently than most other fund managers in terms of people with finance backgrounds and investment banking backgrounds. Our regulatory proficiency, we're going to have much more of a heavy regulatory environment in terms of how we go about audited financials and things of such. And then proprietary network deal flow. You know, we get deal flow from a very particular network. And then investment products. This is really the first direct investment vehicle that we've seen that allows you to access income from royalties in such a direct manner. Market size is big, right? That's everyone's easy slide. And then the team, again, you know, my background's in reservoir engineering. I have our director of accounting, strong background in oil and gas. Marty Tate, strong background in compliance and regulatory environments in terms of helping getting us through the SEC with these new bespoke products. And then last slide, use of funds. We're looking for $1 million to scale up, essentially. The majority of that will be used for building out some investor acquisition components. And then 25% of that will be used for staffing. So if you are interested in learning more, it's my numbers, my email. You also can scan this QR code and get an idea of the type of promotions that we'll be pushing out for the fund. Thank you.
Thank you very much, Maurice. Eric, Bruce Witz is our next presenter with Tech Energy Plug and Abandonment. Looking forward to that presentation.
Thanks, everybody, for being here this morning. I know the drive-in was a little messy for those that did. In particular, thank you to EnerCom for not putting the abandonment guy at the end of the program. So that's really cool. So I do have a confession to make. I never thought I would actually be part of a P&A company, much less start one. That's what we're doing here, P&A, plug and abandonment, focusing on oil and gas assets, wells, facilities, locations. Team's right over here. I've been going since August of this past year. When I first started in the oil and gas business, My first job out of school was working for Shell, deepwater, Gulf of Mexico, subsea completions, a lot of money, big toys, super cool. Didn't have any idea what it all was, but it was pretty neat. Kind of the middle of my career is a lot of new field acquisitions, exploration, development, ops management, stuff like that. Super dynamic, fun team. In the past, third most recently was PE-backed operating company. We go raise a bunch of money, get in early. Did that for 7 years. The group that we're here today with participated in that. That company sold in August of this past year. So what's the next thing you do? Obviously, you go raise a couple $100 million and start PE operating company version 2.0 or a P&A business. And don't think we didn't work on the 2.0 for a little bit as well, but no, this is something I've been thinking about. We've been talking about for over a couple of years. As operators, we were never really able to go out and get the type of services we wanted and the support we needed for a job we really didn't want to do. Right? It wasn't value add for our business, wasn't value add for us. We weren't incentivized to do better, to do some things different on the operating company side. But I think things are changing right now. And that's why we're in it. We're passionate about it. This is an issue for our industry, and this is where we want to be. So we're really operators for operators. The group that is here with us, we're career operators in oil and gas. We've done this stuff for many years, regulatory, environment, permitting, all the ops, budgeting, cost estimations, the whole 9 yards. And that's what we're bringing to operators to partner alongside with them, operators, states, BLM, tribes, anybody who owns these assets. We're not 4 guys with a rig. We're not service company execs standing something up. We're just the guys that have been doing it for a long time and see the need, which I'll get into here in a second. We do embrace technology. We don't have our own IP. We do partner with different folks to bring that, modernize the P&A world. Actually, one of them will be here talking today. Yes, we have a strategy for quantifying emissions, reporting that to operators. Yes, we will be getting into the carbon credit space. We don't have enough time here to talk about that, but it's a pretty exciting and interesting dynamic market that on the P&A side of things actually plays heavily into it. If you really think past 10 years of drilling and completions, just all the advancements that were made. I was talking to a buddy the other day, and he said we started a frac company actually 5 years ago. He was like, we're gonna frac 3 wells at a time, 180 barrels a minute, one fleet. And I was like, man, that's pretty awesome. I'll think back past 10 years, all the advancements in plugging and abandonments. Yeah. The industry advances things where we focus and spend our time, and it's actually amazing what our industry does when we try and we focus on things. I don't think we've really focused on P&A. I think the next 10 years is going to be a whole different ballgame, not only because we want to and it's important, but we're going to be forced to as well as an industry. So an empire of dying wells. Empire of dying wells, or so Bloomberg says. Wrote a little article last fall, and they focused on Diversified. Diversified had an asset retirement obligation problem. Right? Super interesting article. Go take a read if you got a minute. That picture on the right there is one from that article. It is an issue. It's an issue for our industry. Their stock dropped for a little while, and now what are they focusing on? Their sustainability and ESG reports. This is one aspect of it. Idle wells, old wells, non-producing wells. You also see in the bottom right there was a orphan wells, just an updated map. There's only 81,000 wells on that particular map. Estimates are up to about 800,000 from IOGCC. We don't really know. A lot of them are undocumented. Right? This is the challenge we face. Environmental impacts, community impacts, the exposure that we have. It's our legacy. We need to work on it. Nobody really cares where these wells came from. Nobody cares that this field over here helped us win World War I, or this one helped us win World War II. It doesn't really matter. We as an industry need to solve this. And this is why we're passionate about it. And we're going to come alongside the industry and do something with them to fix this. The industry cares. We talk about it a lot. We want to be a long-term solution, a long-term energy solution. We don't get a lot of great press. Well, if we want better press, if we want to be part of that long-term solution, there's certain things we just need to take care of and cleaning up our house. This is one. Civitas is actually kind of a cool story lately, right? They raised their hand and said, we're going to plug 42 orphan wells in the communities where we serve, where we work. Doesn't really matter all the reasons they may or may not have for doing that. They did it. That's a big deal. You're going to see more operators doing it. Maybe not that exact thing, maybe something different. But operators do care, we care as an industry. You'll see the ones that are playing the long-term game, they're the ones that will be doing things like this. They'll be the ones that'll succeed long-term as well. And those are the folks we're partnering with. And as long as the other ones that who just need to do it and get incentivized by regulations. Colorado obviously has pretty restrictive regulations. They're getting tighter. Financial assurance reviews are underway. Every other state, it's not going to get any looser. So the market will start opening up. More and more wells will need to be plugged. There's not enough of us out there to do the work. More and more will need to funnel into the space. We think we have a unique approach to it. We're working with some state agencies as well. They're getting $4.7 billion from the American taxpayer. It's kind of a gift for us, for our industry. Shouldn't really need it, but got it, right? It's coming out. First tranche is already been distributed. States can't, with current orphan well programs, they can't actually deploy that type of funds with the way it's currently structured. So there's different groups like us talking to them on how can they restructure their program such that they can deploy that amount of capital in a relatively short amount of time, 5 to 10 years, to address those orphan wells. A lot of money in the space, not enough people, not enough technology, not enough industry focus. That's why we're doing it. And I should have mentioned, I mentioned the sustainability and for diversified. I think pretty much every operator going forward who does report that way, there's not those line items on your idle wells. How many idle wells do you have? How many have you plugged this year? How many have you cleaned up? What does your footprint look like? May not be on there today, but it'll show up. Investor, market expectation, communities, they'll expect it. If you're looking for an investment unicorn, there's a lot of really cool companies here and a lot of opportunity. On the last one we saw $1 billion numbers, right? That's not what we're advertising. So coming into the space, we're buying equipment, we're going to do everything in-house. We have the engineers, we can support asset retirement, evaluations. We can do all that. But really what we're doing is we're building a cash flow positive business, cash generating business. You're generating cash year one, scalable. As I mentioned before in the last slide, you look at the market, a lot of growth opportunity there as well. Plan is to start small. Initially, the $4 million, that's just to get going with 2 to 3 fleets, right? Prove the concept for those that may not totally understand. And then there's an opportunity either for organic growth within that or go for a larger growth round to really capture the market and it's going to continue to expand over the next few years. I'm currently working with some operators in one of the actually most interesting projects that we'll kick off this summer. We're gonna go dig up a bunch of old plugged wells, right? Re-enter them and replug them with current standards. The main reason you do that, right? So you can do some additional development alongside those. So there's a lot more meets the eye for this pure P&A game than what you typically see your typical wells. There's a lot that we can do with it. And what we're currently looking at is this is just a base platform. And from that base platform, we can launch off into a lot of other opportunities as well as we work with different operators, different assets, see what their retirement obligations are and capitalize on it. So we're sitting over here. Eric Bruisewitz is my name, and the crew's right here. If you want to come talk to us, just say hi and talk to us about abandonment or whatever. Thanks for your time.
Thank you, Eric. I appreciate it. Nicely done. Plug and abandonment certainly would be growing and more important aspect of the industry. Our next presenter is Stephen Brooks. Stephen is the Chief Commercial Officer of American Hydrogen.
Good morning. This PowerPoint load here. Thank everyone for being here this morning, braving the weather to get here. Again, my name is Stephen Brooks, and I'll be presenting today on behalf of American Hydrogen. American Hydrogen is a startup, but not in the traditional sense. It represents a joint venture between two oil and gas companies who make strategic bets on the energy transition and their place within it. Today, I'm here to share a little bit about our company and its role in the broader hydrogen economy. American Hydrogen is a hydrogen generation company. As a provider of steam methane reformation technologies, we offer modular 1, 5, and 10 ton per day turnkey facility designs, in addition to larger, more bespoke generation solutions. Our primary focus at present is a blue hydrogen offering, meaning that at any of our facilities, we are always managing the associated emissions from the hydrogen generation process in some meaningful way. Whether that's permanently sequestering emissions underground, being an injection well, reappropriating the carbon dioxide for sales in markets like food and beverage or industrial gases, or capturing the emissions and utilizing them to support the neighboring enhanced oil recovery process. American Hydrogen was founded early 2019 out of a joint venture between Lone Cypress Energy Services and Reset Energy. Lone Cypress has traditionally functioned as a project management and EPC focused on the development of midstream infrastructure. These include assets like natural gas and crude gathering lines, trunk line systems, cryogenic facilities, and amine treating systems. Essentially, any infrastructure required to move oil and gas from the wellhead to the refinery gate, Lone Cypress has experience developing. Our partner, Reset Energy, is an original equipment manufacturer of natural gas treating and processing technologies. Based in Midland, they have a 100,000 square foot fabrication facility where they manufacture major oil field components, including stabilizers, membranes, and amine treating systems. Together, Lone Cypress and Reset have a long history of successful execution experience, where Lone Cypress would function as a project manager in EPC, and Reset would design all of the equipment that went into the projects. Under the American Hydrogen banner, the roles are the same, with Lone Cypress having oversight over facility design, construction, and operations, and Reset serving as the OEM of our SMR and associated balance of plant equipment. Our management team is anchored by veterans of the energy industry with over 100 years of combined experience working in all aspects of the energy value chain. These include technical professionals with experience in asset engineering, construction, and operations, in addition to financial and business support staff. So one of the questions I'm asked most frequently is why hydrogen? Well, when we consider energy transitions of the past, whether that be biomass to coal or coal to oil and gas, we've always transitioned towards more energy dense fuels rather than energy desperate fuels. Hydrogen follows this trend, having 3 times the energy density of diesel by weight. Hydrogen can also be produced from both renewable as well as fossil fuels. Whether that's taking solar or wind electricity and powering an electrolysis process or the processing of hydrocarbons. In this way, hydrogen really represents the intersection of traditional and renewable energy systems. Lastly, given hydrogen behaves more like oil and gas than electrons, it can leverage much of our existing pipeline, storage, and processing infrastructure. Our team began looking at the hydrogen space in 2017 and 2018. We found that at the time, over 95% of all the hydrogen generated in the United States was done at the refinery scale. These large, centralized sources of supply have historically serviced demand in the crude oil refining and ammonia production processes. Most, if not all, of this hydrogen is gray, meaning that all of the associated emissions from the hydrogen production process are simply vented to atmosphere. This hydrogen is also very low in purity, meaning it is not suitable for fuel cell applications. And this is where we saw a real opportunity. According to industry stakeholders like the IEA and the Hydrogen Council, demand for hydrogen is anticipated to grow exponentially over the coming decade, but not from traditional sources. The world's push to decarbonize is ushering in a new era of hydrogen utilization in a broad range of applications. These include sectors like transportation, industrials, and power generation. And while the supply chains for the crude oil refining and agricultural markets are well established, these new applications will require new distributed sources of supply. And this is really the thesis for American hydrogen, developing distributed sources of hydrogen supply to service the underserved segments of the broader hydrogen market. It's what led us to develop our own IP and our modular steam methane reformers, or SMRs. Our SMRs rely upon a proven process that has been employed at the refinery scale for over a century. We've taken the same operating principles and modularized them. Rather than refinery scale generation servicing multiple customers, our facilities service 1 or 2 end users. We've also integrated a carbon capture and storage system capable of capturing more than 95% of the associated emissions from the reformation process. The result is a blue hydrogen offering made cost competitive by just strategically siting sources of supply near sources of demand. Leveraging our competencies in manufacturing, we are also exploring green hydrogen pathways through strategic partnerships with electrolyzer manufacturers. While we see blue hydrogen as the most cost-competitive hydrogen solution in the immediate term, the future hydrogen economy will require all sources of low carbon hydrogen, both blue and green. Unlike traditional equipment manufacturers, American Hydrogen is a fully integrated company with competencies in engineering, construction, and operations. These competencies allow us to support projects at any point in their development, whether pre-FEED or well into asset commercialization. We structure our commercial offerings to meet the various needs of our customers, whether that's wholly owning generation and selling hydrogen under a long-term contract. So think of customers like an Amazon or a Walmart, who may be looking for a decarbonized hydrogen solution to support materials handling at a distribution center, but have no idea or no interest in owning the actual hydrogen generation assets. Another offering is we have the ability to turnkey generation facilities for an outside operator. This makes more sense for customers like utilities or oil and gas companies who are looking to hydrogen as a means to decarbonize operations. Lastly, we offer technology licensing. This makes the most sense for the projects that we're developing internationally, or for project developers or EPCs looking for a smaller generation hydrogen technology. American Hydrogen has also created a network of strategic partnerships with other prominent members of the energy industry. Memorialized under MOUs, these include entities like Matrix Service Company, with their extensive experience in the design and implementation of hydrogen storage systems, and Tulsa Heaters Midstream, who are currently researching innovative ways to decarbonize conventional burner systems with hydrogen. We found that by leveraging our experience and network within traditional energy, this consortium of companies is well equipped to provide cutting-edge solutions to the growing hydrogen economy. We spent the last several years in the field speaking with customers about what the hydrogen market needs today and anticipating how those needs will change in the future. Our value proposition is a reflection of these learnings. We've rethought the hydrogen delivery model, moving away from hub and spoke generation towards strategically sited, right-sized generation solutions. This eliminates many of the costs associated with transportation, while also ensuring reliability of supply for our customers. We're finding a large market of these customers today. Once marginalized by industry incumbents, these groups are finding cost savings and operational efficiencies in the distributed hydrogen model. By integrating carbon capture with our production process, we're also one of the only producers on the market today able to provide a decarbonized hydrogen product at the purity required for fuel cell applications. Given hydrogen's potential to decarbonize some of our most emissions-intensive sectors, we anticipate this market to grow exponentially over the coming decade. Moving forward, our goals in the immediate term are threefold. The first is strategic partnerships. We are actively looking to partner with oil and gas companies who have assets that are accretive to the EOR or carbon sequestration process. The same can be said of midstream entities. We can leverage existing infrastructure to gain access to markets in the growing hydrogen economy. Our next goal is market creation. We're really in the first inning of creating the supply chains required to service the burgeoning hydrogen market. This is especially true in sectors like transportation, power generation, and oil field decarbonization. Finally, our last goal is capitalization. Over the last 18 months, we've been overwhelmed by the inbound inquiries we've received, both for our technologies as well as our service offerings. We are actively looking for a capital provider who will allow us to scale to meet these opportunities. Our corporate office is based out of Tulsa, with sales offices in Dallas and Houston, and a fabrication facility located in Midland, Texas. In conclusion, I want to thank EnerCom and the Colorado School of Mines for giving us the opportunity to present here today. And thank you to each of you for coming out. I'll be here for the remainder of the conference. If anyone wants to touch base, I'd love to meet you all. Thank you.
Thank you, Stephen. Excellent job. Appreciate that, and certainly appreciate. I got a text before coming up here that our online audience is certainly growing, so we welcome you and certainly everybody that's been able to kind of show up today. And whether that drive, that's great. I appreciate it. Our next presenter, Jeff Williams, CEO of Exim Instruments, extremely disruptive technology in materials testing. So we look forward to your presentation.
Perfect. Yeah, thank you for having us here again. We're really excited. So yeah, my name is Jeff Williams. I'm with Exim Instruments, and we're industrializing mass spectrometry. Don't worry, it's not going to be a lesson in analytical chemistry, but we are here to basically revolutionize the way we analyze the world around us. Most of the stuff we interact with on a daily basis is solid material. But the current way to analyze solids, there's the best technique in the world, is to digest it with a bunch of acids, put it through an instrument the size of a room, have 2 PhD chemists, and use something that looks like this. Nobody in this room wants to touch this. This is a brand new instrument actually here at the School of Mines. This is the current state-of-the-art technology, and it works fairly well, but it misses a lot of things. By contrast, our technology is here on the left. This is the mass box, and this is why I started Exim Instruments. Something that everybody in this room can actually use. They can go touch this instrument, get their data in 5 minutes. They don't need a PhD in analytical chemistry. So, still might be asking, who really cares and why? Well, let me pull this up. This is one of our target customers, Elementum 3D. They're a powder provider for the growing additive manufacturing space. So most of manufacturing is going to additive, especially in aerospace and even in oil and gas. They provide powders to basically every major and minor aerospace company you can think of. Every time their product goes out the door, it has to be quality tested, just like the food you eat. In order to do so, they have to wait 4 to 6 weeks, spend thousands of dollars that goes through 3 different instruments before that product gets to their customer. By contrast, we take 4 to 6 weeks down to 4 to 6 minutes. It's something that they can bring in-house. Not only is it QA/QC for the products that they're delivering, but this is making sure that they can make new powders in a reasonable amount of time to stay ahead of the marketplace. So we're empowering them on every scale of their business here. And this applies to any industry that we can go into. So this graph, you've all seen these before, we're harder, better, faster, stronger. But the real big takeaways here is that we're easier to use. We have access to the entire periodic table, which basically goes back to when they had to use 3 different instruments to measure those powders, we do all those 3 instruments into one on a desktop, one power cord. And we have the same industry-leading sensitivity, the entire room's full of equipment in that 2-foot box. So we were grateful to be here last year. We just started raising our launch round at that point. Well, because of this conference and many others, we were able to close $1.8 million in a launch round, and we accomplished a ton. We had an immense amount of demand for where we were as a company, and we actually had to turn off sales and marketing because we were not ready to meet that demand. We took the year to make sure that we could scale properly and deliver a product that our customers expected and meet the demand for this market. So we redesigned the entire instrument to a full production model that's ready to scale. We expanded our team. We still sold instruments. We won 2 phase 1 SBIR prizes. So that was both with NIST and with the Air Force. And since that, we already have 2 MOUs from the Air Force, and we're really excited to move into the entire government sector, from everything from materials analysis to old B-52 parts to additive manufacturing. There's massive government application here. We won a gold prize in the Mass Challenge Startup Accelerator, which I thought was pretty cool for, a mass spec company. It's not, a very sexy word these days, but I think mass spec is sexy. Anyway, we grew the sales pipeline despite turning off sales and marketing. We were not outreaching. People were coming to us because people have been waiting for this instrument for a long time. The analytical chemistry market has been behind. And we identified which target market we're going to dominate first. Like I said, the entire world around us is solid materials, and there are an infinite amount of markets we can go into. But we want to focus on one and start tackling them on slowly. We've identified material science and additive manufacturing in all spaces, but specifically, providing to the companies that are making powders, making 3D printers, making parts first. And if you're curious about what our sales funnel looks like, we have 2 different categories here. We have customers that already have in-house instruments, those instruments that were the size of a room before, and we have customers that have been completely neglected. They don't have 2 PhD chemists on staff. They don't have the OpEx to cover, or OpEx or CapEx to cover one of these old instruments, maintain running it. It just makes more sense to them to spend $1,000 a sample to get their data. They've been completely neglected by the market. We're more interested in these customers, and it constitutes a much larger percentage of the market. $5 billion a year versus $19 billion a year being spent here. So this goes from first contact to these customers already use this data on a daily basis. They have samples, they have knowns, they give us the materials, they say, do you get the right answer? We do. That very quickly goes to a proposal, and we have 2 options here. You either buy the instrument with a yearly software service contract, or you do hardware as a service. That's something that we're experimenting with this year, and we're going to be defining which path we're going to be taking more. We're seeing a lot of people moving more towards hardware as a service in general, which I think is great. I mean, from a company perspective, it's amazing. Now, the other thing that we're going to be doing this year as we deploy more instruments is we have a really unique opportunity to build the first real chemical database here, because we get to start from ground zero. How do we structure our data in this new era of everything is data science, right? And we get to use our customers' data, and we get to develop a completely leverageable library that we can create the world's first interconnected lab ecosystem. That's something we're going to be moving on to this year. It's not going to be rolled out this year, but it's built into the backbone of our product. As far as what we are going to be accomplishing this year, we are going to be deploying at least 4 instruments into the field, getting a tight feedback loop with customers, making sure we have all the features that they want in the software. The hardware does exactly what we want it to for as long as we want it to in the field. We're expanding this team, and we're reopening our marketing and sales pipeline here. We want to get as many customer leads as possible again, so we're opening the doors because we're ready to service the need of this market. We're going to be selling an additional $3 million in tools, we're going to win at least one of those phase 2 SBIRs that I talked about earlier. And we are opening a Series A later this year. We're currently not fundraising, but we are going to start taking those conversations in Q3 to close by Q4. So if you're in the room and you're interested in talking to us, please let us know. We'll put you on our list when we start those conversations. Also, within your portfolio companies, if you think that there's a really neat application here, we are trying to identify what makes sense for our next best market to go into. So please talk to us about other applications as well. Now, on the investment side, I know that not everybody's investment thesis one-liner says analytical chemistry, but this is a really big market. And this is how these companies grow. They grow through acquisition. We are set up really, really well for this. So most of the budgets for these companies is not in R&D, it's in acquisition. And companies like us are what move this entire industry forward. We're really excited to tell you more about our product. And if you think it's too good to be true, come by the office, put your wedding ring there, and we'll tell you if it's real gold or not. You can see it for yourself. Yeah, thank you guys very much. Ellen and I are here. Please reach out if you have any questions and if you want to be on our list as we start the Series A conversations. Thank you.
I would say for the ladies, the real test is the diamond. So take that over there to Exum and have them check that out, Jeff. I'm sure you'll have a large group here shortly. Our next presenter is Jeffrey Thine with Engineered Salinity ESAL, and he will be presenting for us.
Thank you all for being here this morning. And as Dan said, my name is Jeffrey Thine. I'm the Chief Technical Officer and one of the co-founders of Engineered Salinity. Now, we shortened it to ESAL. Basically, we're a technology company that has developed methodologies to change the wettability. And right now we're focused on wettability of oil fields in particular. We like to say we're the next step in the oil business. The oil business is facing a lot of changes. For 120 years, it's done everything the same way. And yet we're reaching a point where convergent forces, both social forces and economic forces, and just the distribution of oil in the world is going to change the oil business in the next decade. So what do we want to do? We want to be part of that. Our vision is to have a green, sustainable, responsible oil. All sounds good. Sounds almost like something you'd see on an advertisement on TV. However, how do you actually do that? So what's the problem? You always have to define your problem first. The problem in the oil industry is the current technologies, which have been employed for 120 years, only produce a 32% on average recovery. So all the oil wells that have ever been drilled, all the oil fields, on average, only recover 32% of the oil. That leaves 70% in the ground. So the solution that we've developed is to get another 15% recovery. So instead of 32%, go to 45. But you need to do that in a socially responsible fashion, environmentally responsible fashion, and you need to do it economically. Can you do that? Here we go. So we envision the next step, and we call it the oil field of the future. It's a bridge technology between fossil fuel and renewable energy. No matter what we want to say about global warming, what we want to say about the price of oil and all those things, eventually the only scalable technology will be renewable technologies. However, until then, most of the environmental impact and damage is done in drilling, in exploration, not in pumping oil. The only problems with oil being pumped is the CO2 generated when it's burned. And we can offset that at 65 cents a barrel. That's not a problem. So what we envision is no more drilling, no more chemicals in the ground, responsible use of water. We don't need fresh water. We don't need to have huge capital outlays. We don't need high OpEx. What we need is to start including alternative energy sources like solar, wind, and geothermal to power the existing old oil fields. And we need to have a way to bring that more oil to the surface at less than $4 a barrel. What are we going to do with all this? We're going to improve the air quality. We're going to lower the price of the pump, which I think we're all feeling a bite. And we talk about, is Putin going to invade Ukraine and push oil to $5 a gallon? Right now, we're at about $100 a barrel. I think we touched the other day. And people in the oil business love that. But for the rest of us, that's a drag on the general economy. That's inflation in everything that's transported. That's not a sustainable model. We want to provide a sustainable job base by turning those old brown fields, which currently supply 75% of the oil in the world, into gold fields, extend their life 10, 20, 30, 40 years. And the pressure we all face if we're in the oil business is ESG. We all know if we're in the oil business that Engine 1 just got 2 seats on ExxonMobil's board. That the Hague in the World Court found Shell responsible for the users of their product. And Shell is responding by moving to London and divesting themselves in the Permian Basin. These are things we have to deal with. So what we do is design our product to help companies meet their ESG goals. We avoid the use of fresh water. We recycle water from oil production. Not the shale model where you can't recycle water. You have to either treat it and you have to dispose of it, or treat it to a point where you can release it and have another use for it. We want to repurpose the old fields and wells. And you heard from this morning, a company going into business just plugging wells, because right now the model, the green field paradigm the industry's used for 120 years, is fundamentally what the American buffalo hunter did. You took the horns and hides and left the animal behind. That's what we're doing in the oil business, and we can't keep doing it. So, lots of talk. We've heard this before. Everybody's got a product. We're really kind of simpler. We realize that the wettability, the thing that controls the rel-perm curves, that controls recovery in oil fields, is a function of the rock, water, and oil. It's a complex chemical interaction at the nanoscale, and we can talk about all those neat surface chemistry things for all the PhDs and everything. But the fact is, that's how it works. And the one thing we can easily change in every water flood in the world is the chemistry, the salinity and composition of the water that's being injected. And if you can do that and change the recovery, that's the magic bullet. So the question is, can you do it? Everybody says, oh, I can do that, I can do it. Well, let me show you some real data, okay? What we see here, pardon me if I turn away from the microphone. Pardon if I just walk away from the freaking microphone. Everybody hear me? Good? No? Can't hear you. Poor projection in acoustics. I'll try to focus here. These are 2 real fields. So in 2005, an operator, fields were identical, except some of the oil was more biodegraded and some were less. These are decline curves, actual data from the field. The operator decided in 2005 to change the injection water chemistry dramatically. They went from re-injecting produced water at 90,000 total dissolved solids to 5,000 total dissolved solids, injecting new water. So they took all the old water, disposed of it, and just started injecting this new water because they read a paper. We can't find the person at the company who wrote the paper, but this could be why. In the upper case, what you see are 2 things. The decline curve, there's a red shaded area. What happened was 9 months after they started injecting this water, the decline rate changed dramatically. It got worse. That's what we're indicating in the red. In the upper right-hand corner are our lab tests. So we came at this as a post-mortem examination. What we found is, in contrary to many petroleum engineering classes, the best recovery is at neutral wettability, not water wet, not oil wet, right in the middle. And what our lab test showed was where they were, that's the green dot, that big happy face, as we call it, is wettability across the x-axis and residual saturation in the y-axis. So what you want to get is to the bottom of the happy face. That's where you should get best recovery. In the first field, our tests say you're going to get worse. They got worse. 15 years of data. There's no question. The decline rate got worse. The other field, in the lower right-hand corner, our lab test says it gets better. They, in fact, got better. Their decline rate slowed and has been maintained for 15 years. This is real data. This is real money. The project as a whole lost 4 million barrels to date. It's going to lose 10 million barrels if they don't reverse this trend. They lost $267 million and reduced their property values by 80 million. Does it work? Yes. Does it always work in a positive direction? No. We have perfected a methodology that can go in, test this, design the correct fluid, and you can get the benefits. And we can quantify those benefits ahead of time for your financial people. So what's the bottom line? How do we come out of this? Basically, and you see these diagrams all the time, it's expensive to get more oil out of old fields, but we do it for less than $4 a barrel, down to 50 cents a barrel. It's real, talk to us. We can test your field. And what we say is, if it doesn't work, don't pay us. Try that with Schlumberger. Inconsistent low performance? No. We've gotten rid of these problems. People have been chasing this at BP, Shell, Eni, Total, Aramco for 20 years. So some guys in Wyoming solved it. Yeah, well, that's your advantage, not theirs. We don't have extensive changes to normal operations. You're already water flooding in most cases. You had to put a mixing tank on site. Ooh, big CapEx. We don't require more drilling. We aren't capital intensive. It's too good to be true, basically. But in fact, it's real. So where are we going? We're taking thousands of lab experiments that we perform. I think we're up to like 7,500 lab experiments now, accelerating all the time. And we're putting it all into software. 2 years from now, we won't use a lab anymore. It'll all be software. You can sit at your desk, use public databases, and search throughout the world for old fields where this will work and estimate how well it will work. It's kind of like turning those old brown fields that everybody's going to plug and abandon into gold fields. I got that from a musician, by the way, in a bar in Cincinnati. The other thing that we found 6 months ago was our technology also works in carbon storage. We can increase the storage capacity. We can generate a secondary seal. It's amazing. Wettability is an amazing thing. But so this is a whole area that we're just starting and splitting off a separate company in for permitting. Particularly for permitting, the big question is your AOR, area of review. We can shrink that area of review way down. And this number here is wrong. They didn't ask the technical guys. We can shrink the area of review between 100 and 500%. That's a huge savings. And as we all know, carbon sequestration is back. And it's backed by the infrastructure bill. They're going to drop 20, 30, $40 billion on it, depending on how you slice it up. And we intend to be in the middle of that because no one else has the technology to increase storage capacity and storage safety. Where are we right now? We spent the last 5 years building our technology and building a marketing network. So we're working in Montana, New Mexico, Texas, Wyoming, Kentucky, and the Gulf of Mexico offshore. We've just started negotiating, well, I should say that. We have negotiated relationships with the National Oil Company in India, and we're starting in Malaysia. It's very interesting. The further you get from the school of mines, the better you look. It's an amazing kind of inverse thing. And we're starting discussions with some companies in China, Argentina, Canada and Saudi Arabia. So who knows what the next couple of years bring? Why am I here? Our overall goal, and we know that technology can bring us another 1 trillion barrels out of old fields all over the world. Yeah, that's a big target. And the reason I come to this kind of thing is because we're ready. We have 100% equity. We're looking for partners, whether it's buying in equity or some type of loan and debt structure. We're looking to expand. Sorry. Apparently, doesn't like my thing. That's the ask. We're here to look for funding to speed up the process. It's that simple. So if anybody's interested, come find me or look us up on Google. We're number 2 on Google now, going for number 1. And reach out, because this is an opportunity that's not going to come around again. Thank you.
Well, thank you for that. We're going to change up the pace a little bit. We're going to invite up 3 experts in the technology space and have a little bit of a discussion for the next 30 minutes. So I'll invite our panelists to come forward and we'll start getting you mic'd up. Just want to give a quick thank you to all of our sponsors again. They're up here on our screens, but Engage Neighbors will be presenting at lunch, talking a little bit about their geothermal efforts. Haynes and Boone's been a great partner for us for all of our events, including Moss Adams, Gary Climate Solutions, and the City of Golden. What I will say for one other housekeeping item, as folks want to go back and learn a little bit more about these companies, the presentations will be available for download, and they are on their respective company web pages on our Venture Summit website now. So they're uploaded right ahead of the presentation. So our online audience take note of that as well. I encourage you guys to reach out to any and all of these names. And so with that, I'll ask Jenna with Engage to come on up, and our folks from GMT Exploration and Kinder Morgan.
Nice to meet you.
We get settled here. Again, Engage is one of our tremendous sponsors helping us put this event on and supporting this discussion. So I welcome Jenna Valerdi, who's a vice president with Engage, who's going to lead this discussion on digital technology. We're really happy to be joined by Kevin Andrus, who's CFO of GMT Exploration. So someone who's actually evaluating these technologies and implementing them with his team, as well as a School of Mines alum, George Wayne, who's a vice president of marketing services with Kinder Morgan, who's also in a similar role. So I'll turn the stage over to you guys. Thank you.
Great, thank you. So I think, do you guys want to do a quick introduction?
Sure.
Your current roles and background?
Sure. Hi, my name is Kevin Andrus. As Aaron mentioned, I'm the CFO of GMT Exploration. We're an oil and gas company based in Denver. We have operations in Colorado, Wyoming, and Alberta, Canada. I've been the CFO for 3.5 years. Prior to that, I was a oil and gas investor at Invesco Funds. Founders, had my own hedge fund for a bit, called Colorado Capital Advisors, and then spent time at GMT Capital as a portfolio manager for energy investments. So I jumped over the corporate side 3.5 years.
Hi, everybody. Yeah, George Wayne, Vice President Market Services for Kinder Morgan, headquartered out of Houston. Actually, locate myself in Colorado Springs. I have a group that really is in Chicago, Birmingham, Houston, Tulsa, sort of all over, but I operate out of Springs with my crew. Responsible really for the strategy, fundamental analysis, analytical infrastructure that relates to supporting the commercial businesses. Now that's sort of formally what I do, but I've been getting a lot more involved in after our formulation of our energy transition ventures. I'm responsible for coordinating all of the CCUS, RNG, RSG, hydrogen blending initiatives within Kinder Morgan as it relates to integrating with our base business. Also have responsibilities at corporate level as far as our ESG reporting and development. I'm on the task force for climate and financial disclosure and developing our ESG reporting requirements that we really publish every year.
Great, thanks. So the theme today, we are going to be focused on creating efficiencies and lowering costs with technology. So I'm sure you guys will hear that come up quite a bit. But so for our first question, we are going to talk about the types of technology right now that should be top of mind for the investment community. Evan?
I'll probably chop this up, but I'd say, I think from my perspective, anything that drives efficiency, in the organization. And so I would include in that efficiency of processing data, efficiency of processing invoices, efficiency of providing reporting data, efficiency of driving the speed of learning and sharing of information within the organization, I think is incredibly valuable. And just, this business has always been an information business, but it's just the speed of such, I think, is accelerated. And that's kind of how I see it.
Yeah, I mean, to echo that, I've been really starting my career. Coming out of school, really college school mines as a geophysicist working with Shell. I was really surprised at how quickly I got into technology, where we were, obviously seismic data processing, 3D surveys, massive computing power that we actually had at the Shell data center. I think we had an XMP or YMP, a 30 thinking machines that probably had the most computing power outside the government at the time. And we were quickly learning and really writing code, job control language to be able to feed the beast. And it's really ever since then, I've been involved with technology to some degree. And so I think, when I think about the top 3 technologies now going forward, when you think about, I think artificial intelligence, machine learning is right up there. Really to create those efficiencies, to really ultimately lower consumption, because I'll get to it later. We do have a worldwide consumption problem, particularly with less developed countries. Are we trying to really move up the hierarchy of needs, so to speak, or addressing the hierarchy of needs and relates to compared to our developed countries like the United States, where our per capita consumption is 5 to 7 times with less than developed countries. We've got to do something in technology to hopefully address that consumption problem. And I think artificial intelligence and machine learning will help us to solve that to some degree. There's also robotics. I mean, I think about, we're an infrastructure company. We use robotics and even more so to really help us from a safety standpoint and from a process improvement and speed standpoint, move the needle. I think obviously we have smart pigs now. Smart pigs are something you put in a pipeline after a blowdown and run it through to inspect inside the walls of the pipeline for cracks and integrity. That's getting smarter and smarter. drones flying the right of ways to be able to, I think of all the F-150s and 350s we had to go up and down our right of ways to inspect it. All that some with the robotic technology should be eliminated. And then I think of visualization technologies, map-based tools are also coming to the forefront. I've been on a few startups where we really taken advantage of those, really be able to put everything on a map, render it on a map, and be able to query the map to get the information you need to make better informed decisions. There's other things out there. Those are probably sort of my top three as far as particularly my industry. But you've heard of there's certainly quantum computing. There's edge computing. There's blockchain. All those are on the front to help speed up the process and reduce really workflows.
Yeah, I like George's answer, so.
So I was going to dig in a little bit deeper. So for you, Kevin, so you mentioned the transaction process, right? And streamlining that transaction process. Obviously, you're sitting in the CFO seat. So what's the highest impact you're seeing from the C-suite from a finance perspective when you do streamline that transaction?
Yeah, I think internal controls, is certainly a big thing, and I'd expand sort of internal controls to just making sure you're paying the right invoices, you're paying accurate invoices, that you have communication through process. That we're staying on top of our vendor relations, which is just key from a small company, and it's especially key as industry starts to get busy, and you're trying to find slots within drill schedules or frac schedules, or just maintaining relationships with remote vendors. I think all that sort of is key from that perspective. Just cost control. Making sure we're staying on track of whether we're coming in line with our AFE. I would just kind of put all that sort of together, and all of it's equally important, but all of it's important to running an efficient and I think accurate invoice process flow.
And then George, from an operations perspective, how do you think that affects when you streamline that process? You're going digitally, utilizing some of the tools you were mentioning before. What's the biggest impact on the field operations, do you think?
I think it's overall safety and efficiency. And of course, bottom line is the cost reduction. Obviously, want to see the cost reduction. So I think those are really the three. If I was to reiterate again, I think the industry is facing, it's a good problem, but it's a big data problem, okay? How do we make use of all this great data that's hitting our windshield, okay? And I think it's the really intersection of operations, the financial platforms, the operational platforms, the commercial platforms, which all sort of work in silos right now. They don't really work, they work well, but they don't work well in the intersection of all that. And I really think that's where the big nuggets of opportunity are, where the treasures are, where that you can uncover the technology that can envelop all of that and really find the jewels in that intersection of data. And I think, again, some of those technologies will hopefully help uncover some of that.
Agreed. So I think next we're going to talk about challenges. So I think it would be great to hear from each of you right now with GMT and Kinder Morgan. Like, what are your initiatives this year? And then what are you guys focused on? Is there a specific problem you guys as a company are really focused on solving? And then we'll talk about solutions after that.
I think from our perspective, so we have a lot of historical data, whether it's it's partner data, whether it's old well logs, whether it's things that we've had sitting in our our file room for forever. We're going through the process of digitizing that, not only for the speed of access and hopefully the speed of learning, but just really to sort of save space. And so it costs, there's an efficiency element to it, there's a cost element to it. But to do it effectively, you have to be able to access that data efficiently. So I think that's sort of the challenge that we're thinking about. And it takes, to do it right, you have to put a lot of thought to it. I think George, you mentioned it as well. You have just a tremendous amount of data, whether it's financial or operational or regulatory, that you have to manage and put thought to. And I think that's our greatest challenge. But I think it's an opportunity for us to get better and more efficient as a firm as well.
Yeah, if I think about the data challenge from an organization standpoint, we put it in terms of front, middle, and back office. There's certain applications needed, that you need to deploy. Obviously, front office means more your core business, the commercial. Middle office is more you're doing more of the transacting, if you will, and then the back office, I think, is sort of traditional ERP, accounts receivable, billable and payments and credit and all that kind of stuff. And again, there's certain technologies that can specifically address those three, but there's nothing really, and there's some middleware out there that can go in between, but they're not comprehensive enough. And it's really being able to, the challenge that I see is being able to integrate all three of those successfully. Now, one of the things that Kim Warren has been doing over the years, an application has a front end, and what we see is, okay, individuals may go through the front end, but to get wholesale use of the information, you really want to bring it into your back end servers, okay? And I think we probably load up millions and millions of records of very different kinds of data, okay, into our servers, sort of through service, database, data store. Set the table, okay? And then we develop applications, whether it's Python code, other code, to be able to reach in and that's tailored to our specific individual users, where front, middle, and back office. Okay, so they're all hitting the same data, okay, but for different purposes. Okay, rather than going to a front-end application or GUI, going outside the firewall, it's inside the firewall, data integrity, table is set. Now it's just a matter of sticking your knife and fork in it and consuming.
Yeah, I think that's a really good point. I think from some of our customers, from our enterprise customers specifically, what we hear a lot is they're looking to do like an enterprise data hub with AWS, and then they consider that data lake their one source of truth. And so everything that gets in there is validated, and then they can pull data out of there and push it where it needs to go, but at least they have that one enterprise data hub. So
if I could just add one sort of more challenge since we're talking about it, and part of it is getting your organization to buy into new applications and sort of efficiency gains through use of technology. And there are folks, and I think we do a pretty good job at it, but we still fight that. This is how we've done it. This is how I'm used to doing it. We have some great technical folks who've been successful throughout their career, but they've done it, doing it the way they've done it, and so that's a challenge in anything. I'd probably put myself in that category as well. It just takes a while to get used to new ways of doing things. So I think that, to me, just as George was describing some of the things, it's you can have this great technology out there, but you have to get people to use it and use it effectively.
yeah, absolutely. And I think something we see from the customer side is, because you guys have both mentioned AI and machine learning, right? And so there's some really cool technologies out there, like, that do predictive maintenance or, predictive scheduling for any type of work. But if all of your data is on paper, or if all of your, your maintenance records are sitting in file cabinets, it's gonna be really hard to use that data to then, predict future workflows. So, yeah, great points by both of you. I think that's a great effort to be working on, is get your data digital first, and then you'll be able to maximize some of those technologies. All right, so ESG, of course, we're going to talk about ESG today. I've already heard it a couple times in some of the other presentations. It's a focus topic right now. I think some companies, depending on certain investor backing, have different requirements than other requirements. We hear often that ESG is a journey. And so I would like to hear from you guys. Do you have efforts your companies are doing right now to meet any ESG requirements?
Certainly, I can speak for Kenmore, but I think I can sort of speak for the industry as a whole. I have to read a lot of other companies' ESG reports. Obviously, being in the fossil fuel industry, when you think about Wall Street activist investors, they're certainly asking for more transparency and disclosure with regards to climate change. Okay? That's where the climate-related financial disclosure is coming from, is based on whether it's the base case 2 degrees or getting to net zero and everything in between. Tell me what's going to be the impact of your business, okay, going forward, if this were to come to fruition. Obviously, very challenging because that's a crystal ball, so to speak, with regards to what that means. But we have a whole company effort, and I know other companies do, to be able to, we meet regularly to develop that and work that down into the various parts of the organization. What does it mean operationally? What does it mean from a regulatory standpoint? What does it mean from a financial standpoint, reporting standpoint? And so we get all those groups together to develop what we think those implications are, and then disclose that every year in our ESG report. Again, it is a big challenge, but ESG is definitely it's not worn by necessarily one single person or group. It's across the organization. It cuts across the organization. It's definitely multidisciplinary to be able to aggregate the right people to be able to get, to understand and look forward what the implications might be. And I think that's a real challenge for sure. The other one, when we look at what the Wall Street investors, activist investors, we hear BlackRock and such. It's still, the E part is still pretty immature when it comes to what is the right metric to compare against when we talk about those metrics are pretty immature. So case in point is that's topic du jour is emissions. Scope 1, 2, and 3 emissions. First of all, okay, scope 1 emissions, direct emissions, scope 2 emissions, indirect emissions, and scope 3 is the upstream and downstream emissions around your operation. To be able to measure and quantify that is certainly a challenge, right? And technology, we talk about technology, there's certainly technologies out there to help you, are helping us to better measure and quantify what those emissions might be. But we're still up really in the formulation saying is we got the right metric. We know simply what the metric is when we talk about methane emissions intensity or carbon intensive emissions. It's emissions divided by production or emissions divided by throughput if you're moving it from A to B. But the question is, okay, did you capture all the emissions in the numerator? Okay, we know what the denominator is, but what is the numerator? We need technologies to really know, monitor and measure what the true numerator is to divide it by to say that's the emissions, methane emissions intensity or the carbon emissions intensity. And then it gets into, once you can do that successfully, then there's offsets and other things to mitigate around it.
Yeah, and I think from our perspective, when I think about each individual component of the ESG, you know, I think we've, as a firm, and I think that's why they've been successful and for a long time, so before I got there, but is doing things the right way. We're going to do things the right way as a business. Across the ES and the G, and as an investor, even before ESG became popular, and if we look at sort of the performance from a stock perspective, the better performing companies already hit the ES and G going back over time. You sort of couple that with, you know, quality of assets and other metrics that we always looked at for favorable investment. And now, you know, sort of in the term or in the time that we're at now, it's important to memorialize that. So memorialize our efforts from an environmental standpoint, making sure that we're contracting the right companies to help us with measurement, with observation, making sure that we have good safety programs in place that our vendors are required to follow, so that we don't have spills, we don't have accidents that impact the environment, that impact our local landowners, that impact our community. And in memorializing it, using a firm like EnerCom to help us and guide us through that process, you know, is something that we're doing, that we're going to need to do more of. It's obviously becoming more important, not just to investors, but to all stakeholders. And I think, you know, we're a private company, and we have about 230 partners, and all those things are important to them, but there hasn't been sort of a big push down upon us to put out a big ESG report. That being said, though, there are other stakeholders that are going to come in and sort of require us to do so. And obviously, we've heard cases where companies have saved money, have gotten lower rates because they're meeting certain ESG targets. They put out a strong ESG program, and we haven't seen that yet either. But where we are starting to see it is on the insurance and risk side, and so no one is exempt from having to have a more robust ESG program. So you know, I'd say from a social standpoint, I think G&T has always done a good job of engaging our local community, being involved in the community, and really putting forward a wholesome effort, not just all right, we check that box kind of effort, but really getting involved in the community. Our local interaction with our landowners, folks in the community right around our operations, hearing them, understanding, and going the extra step. You know, I think if you're going to operate in a place long-term, you better be a good corporate citizen, a good community citizen. And certainly in Colorado, the regulatory environment is such that it requires that. But I'll go back to what I said in the beginning, you know, doing business the right way requires it really more than anything. And I think if we have strong enough internal goals, we'll exceed those requirements around us and hopefully expectations of folks that we deal with.
Yeah, the last thing I do with that, I think Kevin mentioned it, is the industry, our industry needs to be very thoughtful as far as careful what we put into these ESG reports, because we don't want to be running for ESG washing and greenwashing, because there's certainly I see a lot of that necessarily out there. And it goes back to, it's still early days. It's still is still to be defined. We need better metrics to really be able to differentiate. Is that company really sustainable, really green, as it relates to another company? Because I would tell you right now, there's still really not a correlation between company being green, and they say they're green, and stock price performance. To go back 20 years, I think BP would say they were heavy into renewable solar and wind early on, and they were burned by that. And investors really soured to the notion of their view of sustainability. Now they've retraced that, and they've got a new initiative going forward. Hopefully it'll be more thoughtful, but my point is this, our industry in particular, needs to be very careful and thoughtful of how we craft the narrative and what we put into these ESG.
Yeah, I think, and even going back to our first topic, I think, we look at even just some of the regulatory submissions, ESG, we're all anticipating there's going to be requirements at some point. And so it's a lot easier to submit to these reporting requirements when your data is digital as opposed to on paper. I know, on our end, we do a lot with providing some of the data points, George, that you were talking about, like calculating emissions, right, and these different formulas. So if you can put in place a software to help gather those data points to send over to calculate the reports, or sometimes you can put in place technologies that have all the data points and can support, your scope 3, your waste, and like that, and also help track your service providers, because that's obviously good as well.
And I'll say lastly about scope 1, 2, 3. So I think very few companies, at least in the midstream, I don't think there's any midstream operating with access to scope 3. We just finished with scope 1 and 2. Scope 3 is a massive challenge because it has so many different implications. When you talk about upstream emissions of your operations, downstream emissions of your operations, and implications.
Absolutely. So I was thinking about this one, especially hearing some of the presentations today. And when you guys go out and evaluate technologies, right? I mean, you can come to amazing conferences like EnerCom, and you can hear from some of these smaller companies that are, disrupting the space, or, obviously Google, right? Try to find these new companies. But I do think there's a lot of disruptive companies out there. There's obviously then the legacy larger companies, like the go-tos for some of these technology platforms. So when you guys are going out and evaluating technologies, what's attractive to you? What are you guys looking for when you're looking at a new technology to replace a paper process?
Yeah, I think from sort of our perspective, and we're in a smaller organization, so our process is going to be probably much more informal, than others in larger organizations. And I think we try and provide autonomy to our sort of area heads to understand and decide what's important to them. But then also that fits into our budget, and again, I sort of provides an efficiency or something that we weren't getting before. And so I think that's, I think kind of the first step of evaluating a new technology, something that we haven't implemented before, is it has to be able to fit a need and sort of drive that efficiency of operations, of processing the information. Helps us better understand the financial impacts of what we're doing. But if it's a newer technology that replaces something that we're maybe already doing or partially doing, it has to be able to provide enough of a change compared to what we're doing to offset the, I guess maybe the cost and the mind share, the time and effort involved in implementing that technology. Because there's, obviously there's a lot of things that are there, but it's when you're running fast and you're running with a small group, when you have a new implementation, it does take time and effort. So it has to be able to justify that. So.
Yeah, and so when it comes to how we evaluate, we're not very sophisticated. I don't know if we necessarily need to be sophisticated, but we do have litmus tests that I'll go over in a minute. But when you think about our business, energy infrastructure business, we're very concerned about. So when we talk about cybersecurity and costs and technologies goes into making robots like a cybersecurity around our pipeline, or the technology that will reduce or eliminate safety hazards. That has a different lens than we talk about everything else. Okay, so when I talk about everything else, the litmus test is is there commercial ROI? In other words, how does this technology enable our commercial organization to be able to go out and repurpose pipe, build new infrastructure, get us a better rate, okay? And so that's really the ultimate litmus test, the ROI. Unfortunately, I mean, right or wrong, when you talk with vendors come in and talk about this is going to save you time, money, cost, that needle doesn't really move the needle as much, maybe as it should. And I'm not saying that what they're saying isn't true, but it's the cost. Tell me what opportunity commercially this will bring to the table. Now we can start talking. That's just sort of the mindset.
Yeah, you both said a couple of things. So I think, Kevin, you touched on field adoption. So field adoption. So obviously, if you guys are going to go out and purchase and implement technology, you need your users to use it, right? That's really important. And then also looking at, yes, the ROI, but then I think, and the cost savings, but then there's some additional things on top of that that might be embedded. And so with the use of the technology, you might be able to identify some key performance indicators that may not be just time savings and just a cost savings, right? And so, yeah, my recommendation definitely in the technology evaluation process, make sure that's a focus. I think we're at time. Do you guys have anything else? Okay. Awesome. Thanks, you guys. Thanks for listening, guys.
Thank you all very much. Appreciate that. We will get transitioned here back to presentations. Hydrogen is definitely something that we've had a couple of presentations on. This one I'm pretty excited about. Daryl Smith, Chairman and Chief Technology Officer of Hydrostar, is going to be our next presenter. Pretty revolutionary in terms of their materials and their ability to process produce low-cost hydrogen. So welcome, Daryl.
Thank you. As you said, my name is Daryl Smith. I'm the co-founder and CTO of Hydrostar. It's a pleasure to be here. Thank you to EnerCom. Thank you to School of Mines for this opportunity. And the odd thing is normally I'm in the lab, the guy that's hammering away or cutting parts and making stuff. So this opportunity just to be out in front of a crowd is unique and exciting to me. So thank you for having me today. See if I can get this working. We are Hydrostar USA. We are an electrolyzer company. We make electrolyzers to create green hydrogen. So we're a little different than some of the others you've heard today, but we have a unique process, very disruptive technology, disruptive in a lot of ways. Now, hopefully I'll try to cover those today and help you out. The decarbonization and the efforts to try to move to more green fuels and energy sources there's a lot of things that's gone on in terms of the usage of renewable energy sources and that sort of thing. Now we're getting into some of the more challenging elements, the energy storage, the ability to change fuels, all of those different things and getting into industrial applications, agricultural applications, those sorts of things. So that's kind of the next steps, and that's where we believe we fit in very well. I think I went too far. Let's get this. Let's talk about hydrogen and what it is and what it isn't. There's a color system that talks about hydrogen. Obviously, the gray hydrogen, many of you know SMR technologies. Blue is SMR with carbon capture. The turquoise is pyrolysis, and we're the green. We are electrolysis being fed by whether it be solar or wind, but renewable resources. And that's where we fit, that's our space. So just real quickly, what is electrolysis? Many of you probably had a class in middle school where you took a couple nails, you wrapped some copper wires around them, stuck them in water, turned on a power supply and got bubbles. That's what we are, basically. We're making bubbles. What we're trying to do is separate hydrogen and oxygen from water. So it's a very basic process, essentially. The two key methods of doing it in electrolysis up to this point in time are alkaline and PEM technologies. Alkaline's been around for over 100 years, so it's very mature technology. PEM, not quite as long. We're very different than those. We are a membraneless technology, where both of them have membranes to work to separate the hydrogen and oxygen from their process. We do it in a very different way. We do it in a static way. We spend a lot of time looking at and managing bubbles. Again, that's what we get down to. And we've come up with a very unique technology. The other thing we did in this process of developing or evolving our technology is we not only created the device, which is a coaxial system. Most of the others are flat plate systems. So we're a tube in a tube. We have a cathode inside and we have an anode outside. The other thing that's different about us is we also created our own electrolyte. We do not use potassium hydroxide or any other corrosive materials. We use our own proprietary electrolyte blend. And what that's done for us is it's allowed us to then use stainless steel and plastic parts. And we 3D print the plastic parts, which gives us, of course, some additive characteristics in our process. So we are very disruptive in that regard. Interesting, we started this back in 2012, before that actually, but back in I think it was 2017, this Joule report came out, and it now talks about membraneless technology. We didn't have a classification until that time. We just knew this was the way we wanted to build electrolyzers. So now we're classified as membraneless. So basically what's happening is the hydrogen is evolving on the cathode and the oxygen is evolving on the anode, and without a membrane in between, there's a number of really unique benefits we gain from that. One of them is we don't have a membrane to plug, and so we can use a lot of different water sources. I have a small farm in Oregon, and we use my well water. We don't use any kind of processing before we put it into our electrolyte. We did a lot of work in Beijing, China. We use tap water in Beijing, China. You don't even want to drink the tap water in Beijing, China, let alone put it into an electrolyzer. We're very successful at doing that. We also have some non-standard water sources that we're using, including mine water, and we're looking at doing secondary processed water from refineries and such. Where we're different is, when you start with the material costs for a PEM or an alkaline technology, you have to understand that they're about $400 per megawatt. And that's where you start with, because they use a lot of rare earth metals and other materials, platinum and also your palladium and different things. We don't use any of those. Because of our electrolyte, we're using 304 stainless steel, the most common stainless steel on the planet. Very recyclable, so there's a lot of value to that. And we use plastic parts. We don't have a disposal issue with respect to the materials, the electrolyte, because it is safe, it is benign. So we start off right up front with the low cost elements based on materials alone. Then we get into the simplification of our technology, which is the little device on the left there. And you start rolling out all of the elements that we bring to this picture. We're at about, when released, that's going to be about 6 to 9 months, we'll be at $2 per kilogram for hydrogen. Now that puts us in parity with SMR technologies, which is a very important place to be. At least that's what we believe. So we're very disruptive in that area alone. One of the things with respect to electrolyzers is you get into hydrogen purity, and it's very important that you get up above 95% pure, because below that, now you're in a place where you can easily combust because of the oxygen that's contained in that gas stream. Above 95%, you don't have a combustion issue. So the Hindenburg is not a problem if you're above 95%. We're at 97% right now in our purity, and we're continuing to evolve that. Our goal is to get up around in excess of 99%. But where we're at now, it allows us to utilize our technology in about 90% of the current market. And much of that is industrial markets. Ammonia is about 50% of the current use of hydrogen. Refineries is another massive use of hydrogen. So we're already set up to be able to support those markets and some of the others. The one that's probably a little bit of a niche market and yet to be captured in terms of where we need to be in purity is the fuel cell market. That's still evolving. There's a lot of activities in that area, transportation being one of them, fork truck usage and such. For that market, our current ability right now is to either, in our gas, it's hydrogen and oxygen. There's no other constituents, no other components in there that we have to worry about. So we have to remove the oxygen to get to that higher percentage. We can do that through liquefaction. We can do that through desiccants or any other means in terms of getting to that higher purity if we want to move into that market. However, at the same time, we're still working on improving our technology to be able to get to a much higher purity. So purity is really not an issue for us right now in terms of the market we're in. So we're very disruptive. We list three things here why we're disruptive. The electrolyte is obviously a key component for us, and it allows us to utilize the materials we have. The design is very simple, and we've done that by intent to make the design simple. It allows us to manufacture in what we call a virtual Gigafactory Concept, and which means we can go to anybody who can handle stainless steel and work with them to do our manufacturing. So we can do that in a regional basis. And I'll talk a little bit more about that. We can also take any kind of power. We're an analog system. We're not digital. We can take a variety of power inputs. We've used welders in some of our DC power inputs, very dirty power. And we've also done some work with a DOE SBIR that showed that we can utilize these smaller devices to break up a solar array high voltage DC power. Because an electrolyzer wants high amperage, low voltage, and an array comes out at high voltage, low amperage. So our method is to build in a series of voltage dividers to break that voltage down and carry that amperage through our system, which allows us to be much more efficient and allows us some other significant advantages on the manufacturing side. I won't spend a lot of time with this, but the interesting thing with the infrastructure package that came out through the Senate recently is there were three key things that DOE was looking at. One was to get the cost down to somewhere around $2 per kilogram. As I mentioned, we will be there coming out of the gates. And so we've already met that requirement. No use of rare earth metals, which are competitive features use. They have to because of their process. We don't use any rare earth metals. 304 stainless steel is not a rare earth metal. And being able to utilize non-standard water sources, and we are already there. We're not using RO water or DI water. We're using top water. So we've already met those three elements that their DOE is trying to get. I got to run through this pretty quickly. This Jeffrey's report basically says the globe isn't going to be able to build enough electrolyzers, so there's a lot of market there. Our ask is 12 million. 12 million gets this organization to cash flow positive. We'd love to spend a lot of time on this particular subject, but we'll have to get quickly. Our commercial path is very clean, very easy. We're finishing up some of the engineering elements now. We're moving into system integration of our components and then building them into basically cubes that we would then deploy. We, again, have a very simple but robust manufacturing concept, and then we'll go to market. So the Gigafactory Concept, again, as you look at the device on the left, it's very simple to build. You look at the device on the right, that's a conventional alkaline electrolyzer. PEMs are even more difficult or more challenging. So we're very simple. We can go to any manufacturing process and be able to scale our whole process globally very fast. So again, puts us in a very unique position. Sales projections, there's a lot of stranded wind out there. We've got projects that we're looking at in Tacoma, hydrogen hub projects, and some of those are coming from the infrastructure package as well. So we've identified 48 projects right now, just in the Midwest. So it's a small sample of what's available. So there isn't a question in terms of how the market is. Competitive, we're membraneless, we're lower cost. There's a lot of attributes that we have that our competition is going to find difficult to compete with. Team is incredible. I could spend quite a bit of time just talking about this team. Some of them are here today, so look us up and we'll be glad to talk to you in more detail. Can't spend a lot of time in summary, I only got 17 seconds. So thank you. I really appreciate this time and an opportunity to get out of the shop and talk to you today. So look us up, we'll be glad to answer any questions you have.
Awesome job, Daryl. Thank you very much. I know as I talk to different investors, especially on the alternative side, certainly hydrogen seems to be extremely popular. It's a great opportunity to kind of investigate an investment and kind of put your money to work if that's of interest to you. Our next presenter is Michael Legrani. He's the CEO and co-founder of Iron IQ, and they are a digital technology company making dumb iron in the oil field certainly smart. So, Mike, thank you.
Oh, thanks everyone. My name is Mike Duran, co-founder and CEO of Iron IQ. Iron IQ is a cloud native SCADA provider. We have a really deep expertise in SCADA, mainly in oil and gas, but we have a lot of experience in other verticals as well. We started off a little unconventional in the software space where we actually have expertise. We started off in the field programming PLCs, RTUs, well sites, compressor stations, you name it, all the way up to the communication backhaul systems, adminning, ClearSCADA, Signet, Wonderware, all these big on-prem SCADA systems for kind of the traditional oil and gas SCADA setup as well, getting into the measurement systems there. So I guess we'll, I'm throwing around SCADA, right? And I'm assuming everybody knows, but I often make that mistake. So I kind of want to go into what SCADA is actually. So SCADA stands for Supervisory Control and Data Acquisition. It's used in mission control, mission critical control and remote monitoring applications. It's the primary point of data collection, automated data collection from the field. Alarming, one of the key components is historical data analysis and alarming and remote, basically intervention on your assets. So essentially it replaces, in an oil and gas application, the pumper that used to have to run his route, didn't really know, exactly where he was going to go, and you just kind of run on that. I'm going to run route day to day, right? And you've gotten his pickup and ran throughout the field, and when you ran into an issue, you addressed it. Well, SCADA, it's been around for a long time, 20, 30 years in its current form. It allows them to basically take gain insight from the intelligence gathered from that remote monitoring, and then take action on that monitoring. So you can have more of a kind of exception-based action model as you run your oil and gas asset. It also allows you to remotely intervene. So I can sit on my laptop and I can unload wells, I can shut down compressors, I can set valve positions on my pipeline. It's, as I mentioned, very established in oil and gas. It's very established in mining, power distribution, water treatment, surface water control. Getting a really strong foothold in precision agriculture and other technology businesses as well. Why is it important? Well, it's important because it really is your first, as an oil and gas operator, your first step towards ESG, and that's been mentioned a lot here today. But it allows you a way to actually monitor all of your tanks for overflows, your pipelines for leaks, and more importantly, it allows you to take action on those alerts that come in, right? I have a tank leaking. I need to jump on my computer or have the system do it automatically in maybe a more modern cloud native architecture. I need to shut in that well. I need to turn off that compressor. I need to shut things down if I notice that my pumper's pickup truck has stopped moving on location for the last hour. So that's why it's important. It's also, there's a lot of instrumentation out there. There's a lot of people that create devices, but it's typically the collection point and the source of all of that production data that comes in. And so if you're positioning that data correctly, you can do a lot with it. And as well as it just allows that daily control interface. So what's the problem? We mentioned we worked on all of these legacy systems as a collective group within our organization. Well, the problem is, they're complex and they require a lot to run, and it's a high total cost of ownership, right? Essentially, oil and gas producers have had to make the decision that they're also going to be in the software business as well as the hydrocarbon business. And so they have these big complex teams that maintain these huge in-house systems and create this enormous amount of technical debt that they have to drag around with them as long as they're in business, right? And that system rarely changes. We've migrated systems that are 15 years old at this point. It doesn't run really well in the cloud because it's designed on architecture that was developed in the 80s and 90s. It may have gotten a little prettier, but the underlying framework is still the same. It doesn't allow for easy data access. So any data stakeholder, right, whether it's a disruptive technology or somebody within the organization that needs to analyze a large amount of high frequency data, doesn't allow for that to happen really easy. Certainly not plug and play. And very, very importantly, the Colonial Pipeline, some other hacking instances that made headlines recently. It doesn't lend itself to security very well. Certainly when you start attaching other applications to those data streams. So that's what we're looking to solve. When we're out there talking to customers, we're really opening up the argument that we need to be prepared for the next wave that's going to wash over the industry, right? And so the time to be preparing for that wave is now. And we start talking about companies that that faced circumstances that were unforeseen, and then they essentially, there were other companies that were able to weather that storm a little easier because they made the decision to modernize and get into a better vehicle to carry them through it. So we start having the questions of what kind of business do you want to be? Do you want to be somebody, would you rather be somebody that's manufacturing DVDs and putting those out for distribution, or would you rather be like a Disney Plus type model? Would you rather be a Blockbuster? Would you rather be a Netflix? Heading into COVID, would you rather have been AMC, or would you have rather been Prime Video? According to the Wall Street Journal, AMC in 2020 lost $4.6 billion. The good news is, though, oil and gas never goes through cycles, so we may not need to worry about it, right? So what is Iron IQ? Well, Iron IQ has an upstream oil and gas product right now that we're focusing on called Patch IQ. The main tenets involved in what we're solving in that with this product is accessible, standardized data model. Data model seems very boring until you're trying to actually analyze that data, or if you've ever tried to interface with an unstructured data set that typically comes from these legacy SCADA systems. So we actually have a proprietary data model that we move everything into. We normalize all the data sets, and we allow that to be easily accessed to Power BI, Engage, any of our plug and play application, basically applications that plug and play to our system. We provide a much better system performance because we're cloud native and secure at a much lower total cost of ownership. So we're a SaaS business. We basically replace everything that's required to run SCADA at an enterprise level for your entire organization, including the administrators to run that system for you. We're future-proof, we're scalable, we're adaptable, and we're secure. We can be secure because of our native cloud infrastructure. Right? We're going to be SOC 2 compliant here very soon. As I've mentioned, we allow for easy third-party integrations. We actually have a custom logic layer. So we keep the nature of what SCADA is, and we call it the holy of holies, right? So we don't touch that. But what we have done is empowered some integrations like Node-RED and a couple other things that you can now plug into your data. And you have these smart people in your organization that used to run your SCADA department. Well, now, instead of actually working on just keeping your system alive, you're actually working on solving business problems for you. So they can use this custom logic layer or other tools to actually create some benefit to your organization other than just keeping this big piece of technological debt alive. And most currently, we've actually integrated with we're working on integrating with a company right now that's going to allow us to essentially replace not only Signet, but XBOC. XBOC is a rod pump optimization software. So that's what we're looking to do. We actually just recently closed so we're not looking to raise right now. We're looking to set up conversations for our B round coming up soon. We'll probably be raising $3 million to $7 million fairly quickly. We'd like to, at the end of this year, I think. But we actually closed our most recent round. I think it's actually closing this week. It's oversubscribed, and we're looking forward to the next one, which will be a growth round. If you have any questions, my name is Mike Legrani. My contact information is there. Matt Showalter, our chairman, is also sitting over there as well. His contact information is there. Look forward to talking with you and appreciate the opportunity to be here today. Thank you.
Mike, thanks a lot. Appreciate it. Our next presenter is Tom Smith, U.S. Strategic Minerals Exploration. Carbon capture, utilization, storage, sequestration is certainly a hot topic and something that a lot of investors are looking for. And U.S. Strategic Minerals has a pretty executable strategy for that investment, Tom. So I hope you welcome Tom.
Good morning. Pleasure to be here. First time on campus, surprisingly. I'm a graduate of Montana Tech, Butte. Finally get to be on stage at the Royal Academy after all these years. Pleasure to be here. So here's the investor disclosure. Spend a lot of time on that. Our team at U.S. Strategic Minerals Exploration is very deep. We've got over 250 years of oil and gas professional experience in minerals extraction and management among the founders group. And several of the founders are here with me today. Jim Jones is our president and chemist. He's been around a long time. He's unable to be here, but just recovering from some surgery. Myself, 41 years, oil and gas upstream, Marathon Oil, Whiting Petroleum, all aspects of petroleum engineering from a PE. Dave Laramie is our professional landman. He's run the local shop for the last 40-some years. Initially, it was with Coastal out in Utah, put together some federal units. Jim Huck, ex-Barrett, Texaco. He's our professional geologist and geophysics expert. Also worked with Jim at Whiting. Bert McHugh, our VP of Marketing and Business Development. He's got 33 years in the business. On the marketing side, mainly on the gas side there in the Four Corners area. And Colorado School of Mines ex-geophysics department head, Dr. Robert Benson, has joined us recently as the Director of R&D. And Bob's over here today. So we have a couple opportunities for investors, and kind of fits a lot of buckets here. A big project that we've been touting here for a couple of years is a Paradox Basin brine mining project. So we're going to mine the brine. That's our slogan. It's a $15 million AFE. We're going to do a third for a quarter promote. That's what we're offering. Standard oil and gas terms. There are IDCs available for the promoted partner. The promoted partner will, after payout, have 78% or 75% working interest in as well. The economics are good, based on selling 1,000 barrels a day of brine into existing markets. Calcium chloride brine is essentially what they were trying to put on the road last night, but didn't quite get it all done, so they had to close I-70. So we have the answer to that. On rail, on I-70 itself, about 300 miles west, is our project at Thompson, Utah. And I think most of you know where Thompson, Utah is. It's just before you turn to go to Moab. That's Crescent Junction. Thompson's the exit just to the east. So what we're going to do there is we're going to twin an old well that was drilled in the late 90s by Gulf Canada looking for oil or for gas in the Mississippi. And it's a deep well. They got down to about 14,200 feet and get overpressure. And I'm talking a lot of overpressure. 0.99 psi per foot gradient. And that onshore US, that's about as high as it gets. And so they did not have the mining claims for this prospect. So they had no other choice to plug the well out. Well, our founder, Jim Jones, was smart enough to say, well, you know what? That well flowed a couple thousand barrels a day at 6,000 pounds on a small choke. That might be worth something. And so he's kept that in the back of his mind all these years. And he's done some other stuff out in Utah. When I was let go with Whiting, I joined up with Dave and Jim and said, hey, I know how to get that done. We can drill that well, we'll twin it. We'll get the mining claims. So we're actually mining brine. We don't pay any royalties now because we're running under the 1872 mining law. Aha, all of a sudden our economics look pretty dang stellar because we aren't paying somebody 25% in a royalty. And so we'll talk about that a little more. The second opportunity is a carbon capture and sequestration technology funder. And joining up with us, $2 million each of 5% of our Class A in our S Corp LLC. And with that money, we've got a couple things we want to do. We want to test our carbon capture technology in pilot scale. And we'll either do that at the Wyoming ITC Center up north of Gillette, at the coal-fired plant there, or we'll do an infield pilot. And we're open to one well fields or several well fields. North Dakota is pretty prospective just due to the nature of the brine there that we'll use. We'll talk about how we use brine with CO2 to make a product that actually has a commercial value. And we do want to scale up this technology to commercialization. There's been a lot of people doing stuff in the lab, and DOE's put a lot of money out there, but really now is the time to bring this technology, this carbon capture technology, to commercialization. If you really want to move the needle on net zero and carbon capture, this needs to be done now. We're going to focus some of this new technology that we've trademarked and patented on reuse and repurposing of industrial brines and waste disposal sites that contain calcium. That's the key anion or cation that we're looking at. As a chloride, typically in most of your oil and gas produced waters that come along with the oil, and what's the average water cut in the US? Probably north of 90%, right? So there's a heck of a lot more water being moved around and just being disposed of or used for water flood that has valuable minerals in it. And that's really the point I want to get across today is all of you operators out there have this resource available to you. Let's use some technology, let's sequester some CO2 to make some money. We're going to license the use of our patents to projects with operators worldwide. So the Utah brine mine project, I'm going to skip by this pretty quick. I only got 6 minutes. I want to get into the carbon capture a little more, but we have some cash flow scenarios. I'd like to talk to anybody who's interested in funding this project. It's got great economics, 14-month payout, selling 1,000 barrels a day into existing markets with existing prices. We did a market analysis that said this stuff sells for, in bulk quantities, about $75 a barrel. So pretty shocking, what you can sell specific these industrial brines for. I won't go through this. We do have mining claims, oil and gas leases. It's all federal and state leases we have out there in Utah. We have the patents that actually cover the exploration of this project and actually doing it again. We have this trademark liquid ore, which is really key to our technology. And basically liquid ore is a brine. It's basically any water that you can't drink. So anything higher in salinity and TDS, anything above probably what the Great Salt Lake has in it, is liquid ore. So we follow that up with a couple process patents, and we also can make what we call the Green Mile road base, and that's a calcium carbonate product that is basically limestone. And that's what we make by combining the calcium in the brine and the CO2 from the atmosphere. Here's just a claim stake that we put out there in Utah, just a picture of that. Kind of fun going out there staking claims like the old guys used to do in the hills of ground gold. And little investment return. And this project, it has a rate of return over the project life of nearly 8 to 1. Can't find that very, very often. And no one else can do this. This is something that we found, we patented. This is kind of a one-off project. It needs to be drilled. It needs to be drilled this year. It's so key. There's so many things that revolve around getting this done. We have the copies of this cash flow summary available at our table. Happy to go through it with you, the details, the cash flow and the return. Funding schedule, basically there's a $2 million prospect fee, 13 million drilling and completion, and facilities to get the product to rail. We sit right on the UPRR and I-70, perfect logistically. We get this thing funded here in the next month. We hope to spud in March and be basically that revenue coming in the door in November. Payout 1 year in 2 months, so December of 2023. But really what we're about, we look beyond existing uses for these liquid ore brines. And this is actually a picture of our going into our location. It's about, a half mile up this road here. So we're right in the middle of, no one's going to protest this. There's the Book Cliffs looking to the north. You've got the DOE site. It's actually where they buried the low-grade uranium ore from down there at Moab. So this is a perfect place to drill a well, a mine site. This is what we call our Wheel of Fortune. We talked to some of you guys last night at our table about how we have several what we call low-hanging fruit opportunities in the ice slicer business, the dust control business, and also for drilling fluid. We have 11.4 pound per gallon fluid here, and it's used for drilling. It's well control. But what we're trying to do is open up new avenues for the market. And one of them is using this brine as a geothermal and chemically stable process brine for EGS technology. So enhanced geothermal systems, using this as the reservoir fluid that's being pumped through the rock from the cold well to the hot well. And we have patented technology that we filed last year where we can also actually calcify that feed zone. If you've got a fracture zone that's not really allowing that reservoir fluid to contact the heat block that you're trying to encounter and heat up cold to hot, we can calcify these fractures by pumping CO2 and a pH buffer as a pill, as kind of a workover into these injection wells, these cold wells, and actually divert fluid flow into the areas of the reservoir that aren't giving up heat And so you improve the performance of your EGS project. So we really feel that that's an interesting, people are really thinking that geothermal is all about figuring out how to drill the well. No, that's the easy part. We got that done. You need to make the well economic. And the project economic success is going to be based on this very performance tool that we know we can do using our patents and processes. So we're going to be getting in touch with the folks at Forge here next couple of weeks out in Utah and make sure that, we have this kind of a brine available to them when they start doing their testing down there. Anyway, so we don't have a lot of time left, but a lot of this is on our website. We encourage you to go there. A lot of good blogs and various technical articles talk about what we're doing and where we're going. But really what we're looking for, from an owner operator of an oil and gas field is to say, okay, you've got this water source. Let's say you got 20,000 barrels a day of brine. You know what's in it. You have these water analysis that you have to report to the state. Let's say it's got 20,000 part per million calcium in that brine. If there's a CO2 source nearby, let's get together, let's get a plan of development and MOU going, and we can figure out how to get a project going that'll receive Section 45Q tax credits on that capital investment for the provider, and basically build the facility, capture the carbon, manufacture the what we call the green mile, the calcium carbonate on site, and sell it for additional profit as a revenue stream. Just in closing, liquid ore brines are abundant. Everyone has them. In Texas alone, they're moving 50 million barrels a day of the estimated 100 million barrels a day in North America. So they touch it every day. Let's plug into that. Let's get some revenue out of that, and let's capture some CO2 in doing so. So I think that's about all I have. Look forward to talking with the rest of the folks that we haven't met yet. Great turnout. Appreciate the opportunity.
Morning, everybody. I'm Tim Resvan. I'm a director here at EnerCom, and I'm happy to introduce our next speaker. The company is Photon Vault. They provide low-cost, grid-scale electricity storage services. And here to talk more about it is founder Kent McCormick.
Thank you, Tim, and thank you to the Colorado School of Mines and EnerCom for putting on this event. It's a great change of pace to be able to get out and see people again, so appreciate that. Okay, so what is Photon Vault? The easy one-sentence answer to that is that Photon Vault is fracking for renewables. So I don't need to explain to this audience how much of a game changer that fracking was for the oil and gas industry. It was able to turn marginal shale formations into the top producers. But the fact is, we have a similar set of marginal resources in the renewable space. Those marginal resources are exactly the developed energy markets in places like California and Texas, where we're already in a situation where we have greater than 50% penetration of renewables, and that high level of penetration is driving prices down for a good part of the year, often to levels, just above or even below zero in some cases. So I'm here to present a solution that will enable us to continue to grow the penetration of renewables in those markets. It's a breakthrough in energy storage technology that promises the same kind of impact that fracking did for oil and gas. The solution's based on proven technologies and materials. It doesn't require a moonshot or some kind of massive change in technologies. It's really all about implementation and scale. So what does it look like if you imagine a world where renewables actually increase in penetration to something like 80% of the supply of the electrical grid? Well, the studies that have been done on this suggest that we would probably need something on the order of 1 full day's worth of storage in order to be able to level out the intermittency that's going to be inherent in that kind of a situation. So what does that look like if you were to do this with lithium batteries? Well, we're talking about something like 10 terawatt hours of storage. That's $2 trillion of investment for the US grid. That equates to about 25 times the annual production of lithium batteries today globally, and 4 times where the projected numbers are for 2030. And if you're thinking strategically, you know, the one lithium mine that has been talked about a lot recently is the Thacker Pass mine. It's 100 times the annual output of that mine. So that has led to a huge amount of interest in alternatives to lithium in order to bridge this gap. So technologies that span the spectrum from gravity, compressed air, and thermal systems, right? Using either high temperature heat or heat pumps. And several of these companies, the ones in red, have actually gone public with valuations over $1 billion. So how do we fit into this picture? We're actually a mashup of the last two. So a mashup of basically high temperature heat and heat pump technology. So we have a patented process that enables us to take those two sources of energy, the source of high temperature heat and heat pump heat, and combine them together and store them in our proprietary storage media. Now, the media is critical here because it has to deliver very low cost. It has to be able to bring heat in and out very efficiently. And if you're thinking in terms of scalability, you want to be able to do this with materials that are going to be able to scale to the need that's required. Our solution does that. It's a composite of 5 different materials for the storage media. And the whole system works because we put it together with existing commercial technology for the heat pump and power generation components. So we're not developing anything new there that doesn't already exist in the industrial setting. Now, when you put these puzzle pieces together, what you find is that this kind of solution, relative to something like concentrated solar, which has been out there for a long time, where you take the sun's heat, you store the energy of that in salt, and then you run a steam turbine. That solution has the majority of its cost in the collectors. And for us, if we're running with solar thermal power, our requirements for those collectors are such that our costs are about 80% less than what it would be for concentrated solar. That's what makes this economically feasible. And if you look across the spectrum of the other technologies, the things that really stand out about our solution is that we're very competitive, less than the alternatives for the 4-hour storage requirements, which are where the market is today. That's where you can get paid. And for long duration storage. So as we scale to higher levels of penetration and we need that 1 day or even 2 day in some cases storage, we're more competitive than the alternatives there as well. Because this is a thermal-based solution, we have the durability from those existing components that exist, again, from the industrial sector. And another key benefit is that the round trip efficiency, when viewed purely in electrical terms, can even exceed 100%. That makes it far easier to make money trading in the energy markets today. And so if you were to look at this from the standpoint of a couple of use cases, first one being front of the meter use case, this is some data we looked at, just before the conference when we put the presentation together. So from February 6th, these are wholesale prices in the energy markets. And you can see in California, prices dip all the way down to 0.4 cents a kilowatt hour during the day when all the solar is producing. So good luck making money with that. You have a similar phenomenon in Texas. It's driven partly by solar, partly by wind, and this isn't even the windiest time of the year, but the same thing holds. You basically have the opportunity to make money by shifting that supply of energy from the middle of the day or the windy parts of the day to the times of peak need. As another application, if you're looking That's something that's behind the meter, midstream compression stations, as an example. There you have that same opportunity because you have waste heat. You can combine it with our process with a heat pump, store it in the same energy storage media, and now you have a solution that enables you to provide long-term backup storage for those systems as well. So our team consists of people who are experienced as entrepreneurs in technology and in the energy space. And our current status is that we've completed all the testing on our components, so demonstrated the feasibility of those. We're in the process of building out a full 10 kilowatt system that we expect to have operational at the end of the summer. And the next phase of development, which is really why we're here, is in order to get to scale and build the full 5 megawatt system that's going to become the basis for entering these in front of the meter and behind the meter markets. There we go. So the ask is for us for a couple $1 million to get to the next milestone of development of the full scale system, and then ultimately $10 million, which will take us to give us the capital we need to build the 5 megawatt system. And the business as a whole will take roughly an additional 25 million to get to a full cash flow positive, high growth business. So in terms of infrastructure, not too bad, but there's definitely something there. All right. Thank you for your attention, and I'll be around. So if anybody has any questions, happy to answer.
Our next speaker is Uplift Solar, and they are right before lunch, but the good news is we're running ahead of schedule, so we'll have plenty of time to hear their story. Uplift Solar does power electronics work for the solar energy industry, and presenting today are COO Lauren Rosenblatt and CEO Darius Roberts.
Hi there. I'm Lauren. This is Darius. We're the COO and CEO of Uplift Solar Corp. We make power electronics, but not just any power electronics. We make the power electronics that are going to accelerate our collective transition to clean energy. The problem with moving forward with clean energy is that yesterday's way of thinking about power electronics is holding it all back. Green energy solutions like solar panels and battery storage technology are coming off the manufacturing lines in quantity, and we can have them delivered to our site ready to operate, but we cannot just power them on. We need to hire an engineer, somebody highly skilled and very expensive, to spend a lot of time integrating those systems and giving us custom power electronics, like the ones you see in these blue boxes on the screen, in order to get the electricity we need. 38 to 41%. According to the report by NYSERDA that we have quoted behind me, that is the cost of the percentage of the cost of the microgrids that they studied, represented by the controls, the electronics, the engineering, and the site commissioning. Why so high? Well, it's single versus custom design. One size fits all, or even off the rack, is going to be significantly less expensive than a tailor-made suit for each and every one of you. And the same is true of your power system. When you think about your electric utility grid, it's a single system. It offers one kind of service at a single price for every customer in the same customer class. But if you want a different kind of electric service for your home or your office building or your factory or your remote industrial field applications, then you need to call up that engineer and ask that engineer to make you some of these blue boxes. And the thing about the electronics inside those blue boxes is that they can't evolve as your power system needs evolve. So you probably have to call that engineer back to rethink your power electronics. Also, the real kicker is that of all the components in your system, the power electronics are likely to be the shortest lived. The problem with moving to modern electricity, so we can have the power that we want, where we want it, and the way that we want it, are these boxes. The uplift solution is to get rid of the boxes. Imagine if you could buy the clean energy generation or storage device of your choice and have it delivered to your field of operations, ready to plug and play. A report that came out a few years after the NYSERDA report we quoted, led by a consortium of the national labs, found that by distributing electronics, you could increase automation and coordination and improve system output. At the same time, you significantly reduce the cost of engineering and site commissioning your system. That meant more power at a lower price per watt. That's what we did at Uplift, but we engineered just once a single power management method that can be compatible through a process we call mass customization with just about any clean energy technology that you want to put in your microgrid. Just like conventional electronics, our power electronics will help your system improve productivity, operate safely, maintain situational awareness, and report out that situational awareness to the owner or operator. But unlike conventional electronics, ours are factory integrated and factory defined. So they're optimized to be compatible with the energy device with which they're paired. They're also much cheaper and much more consistent than configuring in the field. They're lightweight, durable, and software defined so that makes them modular. They evolve as your power system needs evolve. On top of that, an energy device that integrates Uplift inside can capture more value and more profit from the power ecosystem. We'd like to give you just a couple of examples of our technology at work. We recently started working with Ashland Energy. They make a vanadium redox flow battery. Vanadium redox flow batteries are long duration storage for commercial and industrial applications. You can see that their battery is on top of that office building in the corner, providing supplementary energy. This can be a cost-effective technology, but the operating system inside that container is incredibly complex, and it all relies on their power electronics. The power electronics have to control the pumps that move the liquid vanadium electrolyte out of the tanks and across the multiple battery stacks. The power electronics are responsible for converting the electrons coming out of those multiple battery stacks into usable DC power. The electronics are also reading and reacting to over a dozen sensors inside that container, addressing things like temperature control and liquid and vapor leak detection. The power electronics are reporting out the sensor data and alarms to a remote location, and these batteries tend to be connected into a building energy management system or directly to the local utility grid, which means the electronics are also receiving energy delivery instructions from a remote location. Using Uplift's patented method of power management, we were able to consolidate and integrate all of these functions into a compact, lightweight, durable set of controls. We replaced the heavy and unwieldy cabinet that you see in this picture with a set of controls that has a footprint smaller than a briefcase. By doing so, we shaved tens of thousands of dollars off of the cost of Ashland's energy controls and also their installation. But more importantly, by making Ashland's battery more easy to manufacture and more easy to install, we help make their products scalable. And another example, we're working with Merlin Solar. They make solar panels that take solar energy to new environments and applications. And what you see here is a peel and stick panel that can go on top of a truck or a motor vehicle to charge a battery. Now, as originally conceived, this panel came with a charge controller, and the customer had to select the charge controller that fit the battery voltage that they wanted to charge, figure out how to hang it and plug it in, not blow anything up. What we were able to do was make a lightweight compact board that slips into Merlin's manufacturing line and can be laminated inside the panel. The board, our board, optimizes production of that panel under conditions of partial shade and also charges the battery directly. So we got rid of that intermediate piece of equipment. The customer no longer has to fiddle with it. Also, the customer can choose the kind of battery they want to charge using our easy-to-use mobile app and load that charge profile onto the board. This makes the panel easy to manufacture, much easier for Merlin to sell and distribute, and the customer has a more satisfying experience, which means Merlin sells more units. Merlin and Ashlon are just two examples of the many clean energy innovations with which we can integrate. What we have here are 4 more verticals in the solar space where we'll be focusing on in the near term. You can see EV charging canopies, transportation, and building integrated PV are just a few. There is huge demand in these verticals for these products, but the innovators are finding that they're hitting a wall because they don't have the power electronics they need so that their products can be sufficiently productive and easy to deploy in the field. Until now, with our rapid integration process, we can give these technologies the precise electronics that they need and also make their use cases viable. I think you're up next.
This is an example of our multi-DC converter technology. So underpinning our technology, we're taking advantage of the new microprocessors that are fast, automotive grade, and highly reliable. The way we're using that speed is in a novel way in DC converters. We are spreading out the main, typical DC converter that you have into many small DC converters. And what this allows us to do is to spread out the heat that's generated into more point sources. This means that we can make smaller components and cheaper components. By working at this granular level, we have different benefits for different things that we integrate with. So for solar panels, we can optimize at the cell stream level, and that can produce more energy. For batteries, we can more precisely manage the energy at the cell level. And that allows us to avoid long-term degradation. This low-level benefit is what actually bubbles up to our systemic level benefits. So each energy releasing node can be coordinated and can shift to a broader range of dynamic voltage output. And this increases the output and the overall efficiency of the system. This is what we call simplexity, when complexity at the lower level, when coordinated, allows the overall system to be simpler and have better outcomes. The other benefits of this very novel way of doing this is that we have a thin form factor and we're highly heat tolerant. And what that means is manufacturing and additional use cases that aren't supported in the industry by other DC electronics. So for manufacturing, like in Merlin's case, we can slip directly inside the laminate of the panel. And that has lots of benefits, but you can see here, for use cases, this is a building integrated photovoltaic system here pictured. And so these systems sit directly against a building. So there's no room in the back for a big box. So we're the only technology that's thin enough and high heat tolerant to go into those use cases and have a distributed intelligence. Distributing the power electronics facilitates distributing intelligence as well. So we can pack as much intelligence as is needed for a use case to enhance the system and overall reduce the cost. For example, this is a rooftop solar system. So in this particular type of system, we would propose that installers can talk to the solar panel system through a mobile app before the panels are even connected. Additionally, with our boards inside, you don't need a charge controller at the end between the solar panels and the battery. You can also eliminate the need to install additional fire safety electronics. All of this cuts down further on installation and equipment costs. And this is really the Uplift mission, to modernize clean and cheap energy for all businesses and people. So lots of companies produce electronics. The companies that do the most to distribute electronics right now are also in the residential solar space. But they're still producing a separate piece of equipment. It's a clunky black box that goes behind traditional solar panels. They can't serve the innovative use cases. They basically are just mass produced for commoditized panels. And they don't have any technologies that can allow them to do what we can do.
Someone doesn't want us to finish our presentation. There we go. In summary, what Uplift can do is lift all of us beyond yesterday's way of thinking about power electronics so that we can move into our clean energy future together. One more note on our competitive advantage, and that's our team. Our CEO is a software expert who has long years of practical experience with real-time complex software. Our CTO is a hardware expert who comes out of the space and aeronautics industry. Our CTO, this is great because we're software-enabled hardware, by the way, but our CTO also has manufacturability experience, and that helps when we work on rapid collaborations with our customers so that we can figure out how to easily integrate our two technologies together. We also have long years of practical experience in the electric and clean energy industries. The idea of Uplift was born from where solar and electric service stood in 2018. And that idea has been carried forward by our thoughtful vision of where both are going in the coming years. I have to mention the caliber and quality of advisors that we have attracted. Because of them, we are validated in both our technology and our business model.
We've come a long way. We started out bootstrapped, and then we won non-dilutive funding from the DOE's American Made Challenge Solar Prize and the Clean Tech Open. We used this money to prototype and solidify our patents. We raised a friends and family round to expand our tech team, to pilot our technology, and to engage with our first customer. Recently, we've attracted seed funding so we're hiring, and we're engaging with customers with a focus on off-grid technologies first. Also, we're partnering with a US solar PV company to build a building integrated PV system, that concept that we have. This is how we think about the rollout of our technology in the first 4 categories of solar that we're focusing on. So there's a period of market adoption or market introduction. And then as our customers scale, we ramp up our unit sales with them.
Our business model is pretty straightforward. After a short period of rapid customization, mass customization with our customer, we sell them units. They can either have us contract manufacture those units and deliver them, or they can license the IP. Our investors make money on our sales. We'll be focusing on off-grid solar applications in the near term, which has high margins. And then we hope to move into grid-tied clean energy applications, which have a period of certification, but also have higher volumes. Our growth will be exponential because as our customers scale and also diversify their product lines with Uplift inside, we grow with them. Currently, we're looking for a lead investor who will lead an investment round for us at mid-year based on our meeting milestones in the first half of 2022. We're also looking for strategic investors who see synergies between what we're trying to accomplish and other companies in their own investment portfolios. We thank you for your time, and if you have any questions for us, then please do find us at lunch or this afternoon, or you can reach out to us after the conference using the contact information here.
Thank you very much. We have had a wonderful morning of ideas, a broad range of topics that will be moving this energy space forward. So I think we're meeting those objectives for sure. Appreciate all of you guys being here. We've met the lunch hour. Lunch will be served back here. What we'll do is we'll grab plates, get settled, visit with your neighbor, and then in about 25 minutes or so, after folks have had a chance to get some food, get seated, we'll invite our keynote lunch speaker with neighbors up to give us a little bit of a discussion on what they're doing, as well as an understanding in the geothermal space. So look forward to that. So thank you all for your attention and look forward to seeing you here soon.